In the last 5 years, I've gone from making $0 a month to making over 6 figures from trading in just 1 month. Just last month alone, I withdrew this amount of money from my multi 6 figures trading account. And for the past 5 years, I've documented every single lesson I've learned along the way on YouTube. And this video contains my best and most effective knowledge that can help you become a consistently profitable millionaire trader. Don't worry, I'm not here to ask you to buy my trading course or join my webinar. There is no trading signal group that you can join for $50 a month. I'm just someone who has put in the work, learned from experience, and figure out what it takes to succeed in the markets. And today, I want to share that knowledge with you. As you can see, this isn't just a typical trading video. It's an in-depth, comprehensive resource that contains everything you need to know about trading. And it's going to take you some time to get through it. But if you watch this video from the start till the end, you will learn the most important lessons that have helped me achieve my trading success. And I'm giving it to you for completely free. With that said, these are my best trading strategies and tips that are handpicked by me personally with specific intentions to provide maximum value. Happy learning. Before you learn what is Forex trading, you need to understand what is Forex first. So the term Forex basically stands for foreign exchange. The foreign exchange market is the global marketplace where the world's currencies exchange hands at a mutually agreed rate, which is what we call an exchange rate. These exchange rates change every single second, so the market is constantly fluctuating. So what we are essentially doing as Forex traders is that we are speculating on this exchange rate, on whether it will go up or go down. Now, the Forex market is actually the largest financial market in the world with a daily trading volume of $6.6 trillion. Not a million, not a billion, but trillion with a T. It is also 200 times bigger than the largest stock exchange called the New York Stock Exchange, right? So based on this graph, you can just see how huge the Forex market is, and it's basically the market where there's the most amount of trading volume and the most amount of people, exchanging currencies every single day, right? So large financial market, lots of liquidity and lots of volume. Now, the Forex market is open 24 hours a day and 5 days a week from Monday to Friday, and it is only closed on the weekends. Therefore, unlike the stock or the bond markets, the Forex market does not actually close at the end of each business day. Now, Forex trading is basically the conversion of one currency into another. Example, you are converting the Great Britain pound to the US dollar, right? So we all have probably seen this, right? At the airport or whatnot. It's basically like a currency exchange booth. So let's say today you go from UK, you go from London, and then you travel to the United States. Maybe you go to New York or something. And in that case, you cannot be using the currency that you use in UK, which is pounds in US, right? You have to convert the pounds into US dollar. So you would usually go to this currency exchange booth and tell them, hey, I want to convert my pounds to US dollar. And then they will give you a certain exchange rate, and then that is when you are able to convert however much pounds that you have into US dollar. Now, when you do that, when you convert your pounds into US dollar, you are essentially participating in the Forex market, right? So, yeah, you probably have been trading Forex without even realizing it. As long as you have traveled to any other countries other than your own one, then you have participated in the Forex market. So, Forex markets are always quoted in currency pairs. The base currency is on the left of a currency pair, while the quote currency is on the right. The base currency is always equal to 1, and the quote currency is always equal to the current quote price of the pair. So this means that the price of the pair, in this case, EURUSD, the price of the pair is this one right here. It's basically stands for how much of the quote currency it costs to buy 1 unit of the base currency. So when you trade Forex, you are essentially buying one currency while selling another. Let's look at this example that we have right here. For example, Euro USD equal to 1.35361. So in this exact scenario, Euro is the base currency, right? Because it's on the left. USD is the quote currency because it's on the right. And what it means here is that it would take 1.35361 USD to purchase 1 euro. Okay. So once again, if you go Google and search, let's say you want to convert euro to USD. So you search euro to USD in Google, and it will probably come up with like a graph that looks something like this. And what we have over here, this is a graph that actually displays the fluctuations of the exchange rate. So you can see 13 May, on the 3rd May, it was probably only 1.08, and then right now it's like 1.09, right? So it actually increased over the past few days or so. So in this case, when you see this right here, this basically means what? The Euro USD is equal to 1.09. So it takes 1.09 US dollars in order to purchase 1 euro. Now, when you buy Euro USD, you expect the price of Euro to rise. So you buy Euro, which is the base currency, and you sell USD, which is the quote currency. Now, if the Euro strengthens against the US dollar, which means the Euro goes up, right? Guess what? You make money. Now, when you sell Euro USD, that means you are expecting, or rather you're forecasting, that the price of Euro is going to fall. So in that case, you will sell Euro, which is the base currency, and you buy USD, which is the quote currency. So if the Euro actually weakens against the Euro USD, right, it actually goes down, then guess what? You make money. So this is essentially how Forex trading actually works. Now, for one currency to go up, there will be another weakening against it. The rule of thumb is that all currencies cannot go up at the same time. Just think about it. It's basically the economy of a country, right? The currency basically stands for the strength of the economy of a particular country. So it does not make sense for all currencies to go up at the same time. There is always going to be a winner and a loser. That is just trading in general. Trading is a zero-sum game. That means if one currency is going up, the other one, the quote currency, is most likely going to go down, right? So same thing in trading. If you win, that means someone out there is losing. If you lose money, that means you're essentially transferring your money to someone out there, the winner, right? So Forex traders actually weigh up whether a currency looks likely to strengthen or weaken against another. Then they trade that pair accordingly. Now let's talk about who actually trades Forex, right? There's a few groups of people. The first one is what we have, the big banks. You know, the investment banks, basically the big financial banks. And we also have your large financial institutions, like your hedge funds, you know, your JP Morgan, basically all the big banks out there, as well as, you know, your hedge funds like the Soros Fund, even Warren Buffett's Berkshire Hathaway. Basically all of these large financial institutions and big banks, they trade Forex, right? They actually manage like pension funds or investment funds, and in that case they're going to use Forex to kind of hedge it, right, and trade with it. And then we got central banks and government. These people are very important when it comes to Forex because they are the ones that actually come up with the policies, right, to actually determine the supply and demand of a currency. And when they do that, that determines the price of where the market is going to go, or where the currency pair is going to go in the long term. And then we got large commercial companies, right? Just think about it. Large commercial companies, they might have employees overseas. In that case, when they pay their employees, they need to convert the salary to their employees' country's currency, right? So yeah, another example could be, you know, when you purchase something from the large commercial company. So let's say right now, example, I'm in Singapore and I want to purchase something from Amazon in the US. In that case, I go to, I saw this book that says that it's $20 US, right? $20 US book on Amazon, so I purchase it. When I do that, once again, Forex comes into play because my currency is SGD, Singapore dollars. So I have to, in order to purchase that, the bank, or rather Amazon, will automatically convert the 20 USD into SGD so that I can pay them with SGD, and then they will convert the SGD back to USD, right? In that case, guess what? I've just essentially participated in the forex market as well, right? So large commercial companies, they participate and trade forex as well. And then there's the small fishes in the ocean, which is us, which is retail traders, which makes up like the smallest trading volume among these other groups that we have right here. So based on this, big banks, large financial markets, these are what we call smart money, and they are the one that actually controls the market, and they're the ones that's actually able to manipulate the market, so to speak, right? So that is why as retail traders, we understand that we have no buying or selling power that is big enough to actually move the markets. So what we can do as retail traders is that we can only try to trade with them rather than against them. That's the only way to actually make money in the markets. Now, how do you determine whether a currency pair is going up or down? How do you know when to buy or when to sell? How do you know that the market is going up or down? You know, how do you like predict where the market is going to go? The truth is, as retail traders, we can't predict where the market is going to go. And we don't have to do so in order to make money. Because trading is simply a probability game, which means that every trade outcome is random. No matter how confident you are on a trade, it's always a 50% chance that you're going to win the trade and a 50% chance you're going to lose the trade. However, what we can do is that we can increase the probability of us winning a trade by developing what I call an edge. An edge is what separates winning traders from losing traders. You see, the thing about beginner traders is that most beginner traders, they don't have an edge, and as a result, they are not able to make consistent profits. Yes, they might make some money here and there, but they will always find it incredibly difficult to profit consistently. But as they master the 3 M's, which I'm going to go through soon, and start to focus on the process rather than the outcome, that is when they will transcend from the randomness of the market and start to make consistent profits. So your edge is basically your trading strategy that helps you make more profits than losses. As simple as that. So in order to develop your edge, you need to master what I call is the 3 M's, right? So the first M is method. You need to have a profitable trading strategy that works in every market condition. The second M is money management, right? You need to know how to preserve your capital so that you can actually grow your trading account rather than blow it and lose your money. That means you need to learn how to take trades with high risk to reward ratio while keeping your risk consistent. And then lastly, you got your mindset, which is where you need to learn how to actually control or rather manage your emotions when you are trading your live account, right? Especially when you have your hard-earned money on the line. You know, all your emotions will start coming into play, your fear, your greed, your FOMO. All these emotions are going to cause you to take stupid trades and make stupid decisions. And as the saying goes, if you play stupid games, you win stupid prizes, right? So you need to learn how to execute trades based on mechanical rules rather than your emotions. When it comes to forex trading, we are essentially trading currency pairs. So these are essentially like your best friend. Now let's talk about what are the different types of currency pairs and which one should you trade. Firstly, you must understand what are currency pairs. Currency pairs is basically a price code of the exchange rate for two different currencies traded in the forex markets. All currencies are identified by their own ISO currency code. Here's what I mean. When you see currency pairs like GP, GBP, GB stands for the Great Britain and P stands for pound, which is the currency for the Great Britain. So you can see all these currency pairs, right? If you look at their name, their ISO currency code, it shows you the country and the currency. And once again, another example, JPY, the Japanese yen. And you can see the first two letters is the country, which is Japan. And then the third letter is currency, which is yen pair. And then lastly, once again, the standard best friend of every forex trader, the US dollar. You can see US, United States, the first two letters, followed by the United States dollar, which is the currency. That is why it's called USD. So basically, all currency pairs are identified by this personal ISO currency code, so that every single trader, when they look at a currency pair, they know exactly what they are trading, what country is this currency pair from, and what is the currency that this guy is actually trading. Now, let's talk about the different types of currency pairs. Firstly, you've got the major currency pairs. Major currency pairs are basically pairs that include the US dollar. Things like your Euro USD, GBP USD, NZD USD, USD JPY, USD CHF. Now, if you're not familiar with this is basically the Euro USD, Great Britain pound against the USD, New Zealand dollars against the USD, and then the US dollar against Japanese yen, and then US dollar over the Swiss franc. So these are basically the main currency pairs inside the forex market. What this means is that these major currency pairs, they have the most amount of liquidity, right? That means most people are trading these major currency pairs. They are like the most commonly traded pairs. This means that the market tends to present us more trading opportunities when it comes to the major pairs. USD CAD, I almost forgot this, the USD against the Canadian dollar. Now let's talk about minor currency pairs. Minor currency pairs are basically pairs that include any two of the major currencies except the USD. So basically, minor currency pairs is basically any of the major currencies like your Euro, Great Britain pound, NZD, JPY, CHF, Canadian dollar. Any two of these major currencies, you combine them together, you get your minor currency pair. And every single minor currency pair, there is no USD inside. It excludes US dollar. So, example, Euro JPY. Euro, a main currency pair, JPY, and also a main currency, another major currency. And then you got Euro CHF, Euro Swiss franc. And then you got GBP AUD, the Great Britain pound against the Australian dollar. And then you got GBP JPY, Great Britain pound against the Japanese yen. And then you got Australian dollar against the Canada dollar. And then once again, AUD against the Swiss franc, the Australian dollar against the Swiss franc. Lastly, you got the exotic pairs. These are the pairs that is dangerous. This is the ones that we don't trade, alright? Because why? Nobody trades them, first of all. Nobody trades them. And second of all, there's extremely low liquidity and low volatility since nobody is trading them, which means price tends to go crazy when like a news event come out or whatsoever. So these are basically the pairs that include one major currency pair and another currency from emerging markets like Africa, Thailand, what else? Mexico, yeah, basically from emerging markets. So it's example like USD SGD, the United States dollar against the Singapore dollar, or the United States dollar against the Thai bahts, and then Euro against the Hungarian dollar. I think that's the Hungarian currency. I don't know what's that. And then you got the Australian dollar against the Mexican peso, and then there's Canadian dollar against SGD. So all of these are examples of exotics. As much as possible, we try to stay away from exotics because let's be honest, you're not going to make any money from trading exotics. And if you're not going to make any money from trading exotics, what's the point of actually going through them, right? This is just for you guys to understand that these things exist. These exotic currency pairs exist, right? But for you, just stick to what's work, which is either the major currency pairs or the minor currency pairs, which will present you much more trading opportunities. Next, which currency pairs should you be trading? That's the million-dollar question. I will advise you, if you are a complete beginner, which I believe you are since you're watching this lesson, stick to the major currency pairs. Major currency pairs like what? Euro USD, GBP USD, NZD USD, USD JPY, USD Swiss franc, and USD Canadian dollar. The reason why I ask you guys to stick to these major currency pairs is because these currency pairs have a lot of daily trading volume, right? And they are the most commonly traded currency pairs in the world, which means that they're going to give you sufficient trading opportunities, right? Especially if you are a beginner, you will start to see a lot more trading opportunities as you begin to level up in trading, right? And these are the major currency pairs they can go to. Now, the good rule of thumb that I always tell my students, and what I do myself, is that I will always stick to 1 to 4 currency pairs. Right here you can see this is my watch list right now, and this is what you should not do at the start of your trading journey, right? At the start of trading journey, I will absolutely just ask you to focus on mastering 1 to 4 currency pairs max, right? 4 is like the maximum number. That's like, you should not go more than 4 if you are a beginner, right? And it's always going to be better if you become a master of one rather than a jack of all trades and master of none. Right, so I'll advise you, if possible, focus on mastering one currency pair And maybe the reason why I want you guys to have at least like 3 currency pair inside your watch list is because if that one currency pair does not provide you with trading opportunity on that day, you can look at trading opportunity from the other 2 currency pairs, right? So yeah, stick to 1 to 4 currency pairs. And the reason why I have like 7 currency pairs right now on my watch list is because I'm an advanced trader, right? I've been trading for 4 years now. I know exactly what I'm doing, and it's much more easier for me to analyze the charts and actually come up with my buyers and stuff. And right now, the thing is, I don't even like really trade all of them. You see, what I do is that I put like a red flag beside the currency that I believe that there's going to be an upcoming trading opportunity, and that's the one that I'm concentrating on. So if you look at this, I'm only concentrating on like 2 currency pairs, which is GBPAUD and NZD/USD currently, because I believe that there's going to be an upcoming trading opportunity. So like I said, focus on maximum 4 currency pairs and you'll be good to go. Now, in order to become a forex trader, you have to understand the way we speak. You have to understand the terms inside forex trading. And that is when I want to teach you guys the forex language and lingo. This is like somewhat like a dictionary for you guys to understand the terms that is commonly used inside forex trading, or rather used by forex traders. Firstly, what we have is pips. Pips is basically what I call, or rather no, not what I call, but what is called percentage in point. It basically stands for the amount of change in the exchange rate of a currency pair. A pip is the 4th number after the decimal point. So 1 pip is equal to 0.0001. So if you look at this currency right here, EURUSD, right now its quote price is 1.0926. In this case, the pip will be the 4th number after the decimal point. So this is the decimal point, 1, 2, 3, 4. There we have, that is your pip, right? So over here, right now, this is the pip. So it's basically the 4th number after the decimal point. So if this goes from 1.0926 to 1.0927, that means it increased by 1 pip. On the other hand, if this goes from 1.0926 to 1.025, that means it decreased by 1 pip. Now, let's go through a few examples. So in this example right here, price went from 1.2468 for EURUSD to 1.2470. In that case, you can see price just increased by 2 pips. Okay, and then another example right here, price went from 1.2576 to 1.2566. Price just went down and fell by 10 pips. Remember how you get these 10 pips is you take this 76 minus 66. You get 10 pips. Over here, 68, 70, 70 minus 68, you got your plus 2 pips. And then last example right here, 1.2176, and it increased to 1.2276. In that case, you can see this right here went from 176 to 276, so it's basically plus 100 pips, right? So as time passes, you will start to familiarize yourself with this concept of pips, right? This is essentially like how we used to measure the change in the exchange rate of a currency pair, and it also allows us to measure our profits or loss. Now, for Japanese yen pairs, it's a little bit different because Japanese yen pairs only go up to 2 decimal places, right? So EURUSD, all the major currency pairs, all the minor currency pairs, they have like a string of numbers like this, right? But Japanese yen currency pairs, they only go up to 2 decimal places. So you look something like this, 170.67. In that case, 1 pip is the second decimal place, the number in the after the, yeah, how do I say this? The second number after the decimal point. So in this case, the second number after the decimal point is this one right here. So this one right here is your pip for Japanese yen pairs. So if price of Euro JPY go from 170.67 and it increased to 170.68, then guess what? Price just increased by 1 pip. If price goes from 170.67 to 170.65, price just decreased by 2 pips. Now, there's also this thing called your pipettes. Pipette is basically micro pips. It's 1/10 of a pip. So a pip is like the 4th number after the decimal point. A pipette is basically the 5th number, right? So in this case, usually if you go to TradingView or your broker, you will see that the currency quote price looks something like this, right? The string of number that we have right here, and then there's like this small little number right here on top of like basically the pip. Yeah, on top of the pip count, there's this small little number. In that case, that is the pipette. So right here, this is the pipette, and if price goes from 1.09263 to 1.09265, you can see the pipette change, right? So 3 to 5, this means it just increased by 0.2 pips, right? So 1 pip is basically 10 pipettes. So it's like 0.1 pip is this number right here, right? So if price goes from 1.09263 to 1.09265, that is plus 0.2 pips. Now, lot size. Lot size is basically the size of your position, or rather how many units are you buying or selling of a particular currency pair, because Forex is traded based on lots. Now, there's 3 types of lot size. First one is the standard lot, the biggest one, and that is when it's what is called one lot, right? It's like a volume, one lot. In that case, that means you are either buying or selling 100,000 units of that currency pair. So if you are buying one lot of Euro USD, that means you are buying 100,000 units of Euro USD. And that means every time price increase by 1 pip, you are making or losing $10. And every time price move by 1 pip, that is $10. Okay, then next, there's the mini lot, which is your 0.1 lots. In this case, you are buying or selling either 10,000 units of Euro USD or GBP USD, right? In that case, every time price move by 1 pip, it's only a $1 increase or decrease. And then lastly, you got your micro lots. That is your 0.01 lot. That is the smallest lot size that your broker will allow you to trade with. In this case, you are buying or selling 1,000 units of Euro USD or whatever currency pair that you're trading once again. And this time round, whenever price move by 1 pip, it's only moving 10 cents, which is $0.1, right? So that is your lot size. Now, I want you to make sure that you really familiarize yourself with these terms. Firstly, bullish. Bullish means that you are expecting price to increase. Bearish means that you are expecting price to fall. So if I say that I'm bullish on Euro USD, that means I'm expecting Euro to go up in price. If I'm saying that I'm bearish on Bitcoin, that means I'm expecting Bitcoin to go down in the near future. Long means buy, short means sell, right? As simple as that. So if I say that I'm longing Euro USD, that means I'm buying Euro USD. If I say that I'm shorting Tesla stock, that means I'm selling Tesla stock. And then stop loss. Stop loss is basically a preset price where your broker will automatically close your open trade, your open position, if the trade does not go as planned, right? So when this happens, it protects your capital and it prevents you from losing more money than you want to lose. And then your take profit is the profit goal that closes the trade if the trade do go as planned, right? So if you manage to win the trade, that means that price has most likely hit your take profit, right? Price most likely hit your take profit and you got out at the goal that you set out for yourself for this trade to play out. In that case, the trade went as planned, it hit your take profit, you make a profit, right? Then stop loss is basically the opposite. So if the trade does not go as planned, the broker will automatically close the trade at a preset price and prevents further losses. So now I'm gonna show you your new best friend for the next 5 years or 10 years or however long you plan to trade. And it's this beautiful software called TradingView. So go Google, search TradingView, right? And click on the first link right here, TradingView Track All Markets. This is basically your analysis platform. This is where you actually do your analysis when it comes to your charts or whatever you're trading, be it crypto, stocks, forex, futures, whatever you're trading, you're going to be analyzing your charts here. So like I said, this is going to be your wife, your new wife, or new husband for the next few years or so, right? So make yourself comfortable. So first thing first, when it comes to this website, it probably looks something like this. Don't know if it's the same guy or not, but it looks something like this. So just go to products, and then yeah, you probably see something like this. Or maybe you can just explore around here. There's even like the community that they have right here, and then you can see the different sort of stuff that you can trade. You got stocks, you got ETF, you got crypto, forex indices, futures, bonds, even about the economy, some stuff about the economy. There's news as well, and these are the brokers that's integrated with TradingView, and then yeah, there's more stuff right here. So just go to products and just go to super charts. This is basically where you can actually get the charts. And then if you press this search button right here, you can search anything that you want to trade and it will appear. So let's say you want to trade Tesla stock. Tesla right there, just click on it and then you can just launch the chart of Tesla. But in this case, we are trading Forex, so let's just search Euro USD. So I just click Euro USD. And bam, I will have the chart of Euro USD. Right, so when you look at this, all of this stuff right here, this is basically your Japanese candlesticks charts, right? So Japanese candlestick charts, I'm not going to talk too much about Japanese candlesticks in this lesson. This is just a walkthrough on how to use TradingView. Japanese candlestick lesson is the next one, I believe. So yeah, but basically right here, this basically shows you price, right? All of these Japanese candlesticks help you understand who is actually in control of price, whether it's the bears, the sellers, or the bulls, the buyers, right? So that is basically the chart section. Just go through section by section with you guys. So maybe we start with the right hand side. So the right hand side, we have your watch list, right? At this watch list, you can just add whatever you want inside your watch list. You know, you want to trade EURUSD, and then you want to add all your major currency pairs, GPUSD, and then USD JPY, USD CAD, and then maybe even AUD USD, right? Just add all of these currency pairs, whatever you want, onto your watch list, so they can just focus on these few currency pairs. And if you want to remove any, just press this X button right here. Bam, it's gone. Right? And if you want to add, just press this plus button. No rocket science right here, right? Right, so once again, you can actually put like whether you want description to show or you just want the logo, the ticker, which most of you guys just select the ticker so it looks more clean. And then over here, you got alerts, right? So alerts is basically where if you press this plus button right here, you can set an alert at a specific price point, right? So let's try it out. Press the alert button right here. And then let's say you want an alert that TradingView notify you when price crosses maybe 1.10, right? So 1.10, I want an alert, right? So you can choose whether you want it only once or every time price actually crosses 1.10. And then you can then choose what alert name you want. Maybe you want to put analyze Euro USD, right? So put it on. Once you created the alert, guess what? TradingView will personally send you a notification when price eventually reaches this 1.10 level. It will send you something like either a message or an email telling you that, okay, bro, your USD is at 1.10. You can start analyzing it or whatever you want to do with it. So let me just remove that. And then next, right here, this is the data window. It basically shows you all the data about the thing that you're trading, be it currency pair or stocks or whatnot. It shows you all the data right here. You can see the high, the low, everything. It just adjusts depending on your cursor. Yeah. So, and then you got this window right here, which shows you all the different sort of stars. Yeah, basically everything like US exchanges, all sort of stuff. I don't really use this honestly, so we can just ignore that. And you can see this is where you can even create your own ideas when it comes to the charts. You know, never really use this once again, but yeah, this is where you can actually publish your trade idea, right? And then this is a chat function where you can actually chat with other people, be it in the forex community or the cryptocurrency community or even the stocks community or whatnot, right? Or even gold, right? You can just have a chat with people, see what other people are doing, you know. Yeah, I wouldn't really recommend you guys to use this chat function because our goal is to help you become an independently, consistently profitable trader who's able to think on his own feet and trade independently without relying on other people. So yeah, I wouldn't really recommend you to use this, but if you're bored, you know, why not, right? And then this is other people's ideas, idea stream, other people's ideas, right? Once again, wouldn't recommend you to use this. I don't use this myself, and just yeah, and then yeah. So yeah, that's basically for the right side. Now let's go to the left side, right? No, actually, let's go to the top, right? So top right here, once again, this is a search button right here. It's the same thing. You search for whatever currency pair that you want to trade, just search right there, and then yeah, you can just, you know, whatever you want to trade, just search right there. And then right here we have your time frames, right? So over here, these are basically the time frames that actually you want to trade on, right? So whatever time frame that you're on right now, each candlestick represents that time frame. So if you're on the daily time frame, what this means is that each one of these candlestick represent 1 day. So this is 1 day, this is 2 days, this is 3 days, 4 days, 5 days ago, 6 days ago, 7 days ago, right? So basically, this is how the time frames work, right? So whatever time frame that you're on, the candlestick literally represent that time frame. So right here, this is the 4 hour time frame. You can see the time below or the bottom axis. You can see this is at 9 a.m. and then this is at 5 a.m. which is 4 hours ago, and then this was at 1 a.m. which is 4 hours ago, right? So basically that's how the time frames work. If you're on a 15-minute, same stuff, right? Each one of these candlesticks represent 15 minutes, and you can see right now this is 12 p.m. and then this was 15 minutes ago, which is at 11:45. This candlestick was formed, and then this is at 11:30, which actually created this candlestick right here. And you can see right now is actually creating a candlestick. It's creating the 15-minute candlestick, and you have the timer right here, which shows you how many minutes remaining up till this 15 minutes is up, and then the entire candlestick will be formed, right? So we don't know whether it's going to be like something like this or something small or whatnot, right? We still don't know what's going to happen, right? We have to wait until this timer is up, wait for this candlestick to fully form, and that will be your new 15-minute candlestick, right? And then yeah, you can see these are basically all the time frames, right? Whatever time frames that you want to have on like your favorites right here, have it on display, just press the star button beside it, yeah, and you will have it. And then next right here, this is basically your different sort of charts, right? So there's bar chart, there is hollow candles chart, there's volume candles. Okay, this is a free version, right? This is basically another of my account. I have like the premium version, like the most expensive one, because TradingView was kind enough to sponsor me, right? But basically, if you're on a free one, yeah, you are limited to certain stuff, right? So yeah, you're limited to certain features, yeah. But you can see basically this is where you can switch all the different charts that you want, and some is like paid, like the volume one right here, yeah, like this one right here, which is really really cool, but it's paid, yeah, and you need to upgrade and stuff, right? So certain features are unlocked, but overall this entire platform is free for you. But if you want additional features, then you can consider getting the paid one, right? So if you're just starting out, I'll just recommend you to just take the free one. That's what I did, right? Just take the free one, is enough for you. And then indicator step right here, actually you can get whatever indicator you want. You can just search, okay, I want RSI, and then RSI, boom, relative strength index, boom, indicator right here. Maybe I want a moving average, then boom, moving average right here, yep, you can see right there. But at 1% club, we don't teach you how to use indicators, so just remove all that bullshit, right? So next, this is your templates, right? You can actually save the indicator template and it will just appear right here. So like this, this, you know, it's like different templates basically. And then once again, the alert window, same stuff. And then there's a bar replay tool, which allows you to, you know, go back in time, right? You can see, you can just go back in time and boom, you are literally back on April 1st. And then you can actually, you know, you can see the price moving, which is really, really cool. You can change the replay speed, make it a little faster, you know, and then boom, 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 boom. It's basically like a time machine where it allows you to go back in time and then jump to present. Then there you go. So that's basically the bar replay. But the free version only allows you to bar replay on the daily time frame. So if you're gonna go down to like the 4-hour time frame and bar replay, it will require you to get a paid version. Right? You see right there. Yep. So yeah, that's basically for the top bar. And then before I move on to the left side, I want to talk about how you can actually change your how your chart look like. So you press right click on the charts and then you press the settings, and this is where you can actually change your candlesticks color, right? Maybe you want it to be blue, and then maybe you want the other color to be light blue, right? And then you can change the border color as well to blue and light blue, so that you know it matches itself. And then boom, yep. So you can see you just change your entire candlesticks color, and then you can also change like the grid, like the background, right? So if you don't really like the grid, not a fan of it, you want to keep your charts as clean as possible, you can just go here, you know, you can change the grid lines to none, and you can even change the background color, maybe on black or I don't know, gray, or yeah, whatever. Or you can even choose like a gradient color, which is quite cool. Choose 2 colors and it will look like a gradient thing. Yeah, so for me, I just stick with white most of the time. And then You can even add a watermark if you want of like the currency pair. You can see it'll just stay there forever. Yeah, and the rest of the stuff you can just go explore on your own, but basically that's how you actually customize your charts and really make it clean and make it really personalized. Once you're done with that, make sure you save it as a template, right? So just press template right here, save as. Maybe I want to put like the sea waves color, right? Then just save it, right? You do this because like next time, you know, for some reason your charts look like this again, then you can just press like right click, go to color theme, and you can actually change the template that you actually save at, which is like this. Yeah, so that's basically how you do it. You can see that I have like different template right here, the red and blue one, and YouTube one, and yeah, this is a normal one. Right, so yeah, that's basically how you customize your charts to make it your own. Once again, you must make yourself comfortable because like I said, this is going to be your best friend from now on. So might as well make yourself feel comfortable, make yourself home, right? And then let's go to the left side. This is where you will spend the most time on, right? This is where you actually get all your tools. So you got the trend line tool right here, which allows you to draw a line, which is cool. And then you got like, I'm just going to show you like the ones that I use the most. And you got horizontal ray tool right there. And then you got horizontal line tool, right? Just put that in, horizontal line, and it just goes like, it's just like an extended line like this, and it just drags all the way across the charts. And then you got your Fibonacci right here. And then, yeah, once again, I'm just going to show you the ones that I use because I don't really touch all of this stuff actually. Like most of these, have never literally used it before, right? And then, yeah, all this stuff, I don't really use it before, but I can just explore. I don't even know what this is. Yeah, some stupid pattern, ABCD pattern, right? Yeah, so... And then you can have your long position too, which actually like kind of forecasts, you know, what price is gonna do. Place your stop loss, place your take profit. If you're entering for a buy, this will be a long position too, which will be very useful to actually forecast your risk to reward ratio, or your short position too. If you enter for sell, place that there, set a stop loss, set a take profit, find out what's your, you know, your risk to reward ratio right there in the middle. So yeah, that's the tools. And then there's another very useful tool, price range tool, which allows you to calculate the pips, right? So let's say I want to calculate what's the pip from here to here. Then I just drag it from this all the way up here. And then this last number right here, 125 pips, it basically tells me like how many pips move is this, right? So it's just a 125.6 move. So it's very useful. It doesn't require you to manually go and calculate the pips. It just do the hard work for you. And then there's like a bunch of emojis right here. I don't even know why it's this emoji. And you can add a text, right? Say, hi, I'm Brad, right? Whatever you want. And then you can double click on it. You can customize the color that you want, right? Make it bold or whatever, white or whatnot. You want to increase the size. Yeah, you can do on background, boom. Change your text color, boom. You know, yeah, you can just go and play on your own, right? You can add text. And then you can add a call out as well that says, okay, I want to mark this part. And they say, this is bearish candlestick or something like this, right? Something cool like this. Yep. And then the rest of the stuff, don't really use it. Once again, yeah, then this is where you can just remove all your drawings at once. So if you have like multiple drawings, you can just press remove drawings, or you can remove all the indicators. And then this is where you can actually hide your drawings. So let's say like, you know, you marked up a bunch of stuff here, right? Mark up a bunch of stuff here. Like let's say you got this, and then you got this, all this stuff right here. You press this, it just hides everything, right? Just your candlesticks alone. And then once again, if you want to remove all the drawing, just press this, remove drawings, right? And then yeah, the rest of the stuff you can stay in drawing mode right here, which allows you to keep on using the tool that you are stuck with, right? So which is really cool. And yeah, that's basically it. And then at the bottom panel, this allows you to connect to your trading broker, right? Only these brokers that you have right here, you see right here, these are the brokers that can actually connect to, right? So yeah, and then this is the strategy tester, which I don't really use. Pine editor, don't really use this as well. Yeah, so the rest of the stuff I don't really use it, but you can explore on your own. But this is basically how I personally use TradingView, right? These are the tools that I have. And once again, before I forgot, this is the favorite tools bar. And if you want to add like your favorite tools into like this little toolbar thing so that it appear like this, you can just like easily access it like this, right? Whatever tool they want, just easily access it, right? You need to go to the tool that you like and then just press the star button beside it, and then it will appear on this toolbar right there. Hey guys, so this is a tutorial on how to actually use MetaTrader 4 to actually execute your trades. First things first, you need to go to your App Store or Play Store or whatever you have on your phone and search MetaTrader 4. Right, this is the one that I use MetaTrader 4. There's also MetaTrader 5, which is the more updated version. The software, the interface is a little bit different, but essentially the same thing, right? So I just like to use MetaTrader 4 because I've been using it for so long, and yeah, there's not much difference between MetaTrader 4 and MetaTrader 5. It's just that MetaTrader 5 is just more updated. It just looks much more updated, right? So MetaTrader 4, once you download it, open it, and it looks something like this, right? So first things first, you need to go and set up your account. So press settings right here, and then press this button right here. This actually allows you to add your live account or even create a demo account if you want, right? So just press this plus button right here. So two options, either you log into your broker like a live account or like open the demo account. So if you're practicing, you can open a demo account that will be trading with virtual money. It'll be like a fake money that you can actually play with and actually practice your trades. Now on the other hand, if you are ready to actually connect your broker, right, just press this button right here, and then you search for broker right here. Let's say you're trading forex.com. Maybe like let's try Oenda right here. You can see, then you basically choose the live broker. Basically, if you sign up like a live account with your broker, it will show you the exact details on which one to choose and all that stuff. So yeah, choose one, yeah, and then basically the instructions will be inside the email that you actually sign up the broker with, right? So I'm not going to show you how to do it, but this is basically how you actually set up your live account. Just press this and then just go set up your live account. And this is where you actually open a demo account. So right now I already have an account in place. This is like a live account right here. So just going to walk through with you what we have right here. But it is like an old live account. I didn't realize that I have like $1,000 in this account. This is from like 2 years ago. Yeah, this is like a spare phone. You can see this shitty phone. Anyways, so let's go through this. So first things first, when you go to quotes, this is basically where you get all your currency pairs, right? So all your currency pairs, it's like a watch list on TradingView. If you want to add currency pair, just press add button, and you can add like forex currency pair. Just press this green plus button, and it will go to your watch list, right? So whatever you want to add, let's say you want to add some Euro JPY or something, just search, and then yeah, just add Euro JPY, add right there, and then it will appear here inside your watch list. Once again, this is something like a watch list. There's an advanced tab, and there's also a simple tab like this. If you're a beginner, just stick to the simple one. So if you want to trade, right, just press the currency pair that you want to trade. Let's say I'm trade EURUSD, press trade, right? And the other one is, it shows the chart. If you press chart, it will show you the chart of EURUSD. Let's go through the trade first. And then if you press details, it shows you the details of, the spread and the margin and the other stuff, the swap and all that other stuff, right? So let's say EURUSD, let's press trade. Okay, so when it comes to here, this is basically where you actually execute your trades, right? This is where you actually place the buy or sell order, right? So this is the price that you'll be buying at, and this is the price that you'll be selling at. And then this is basically where you input your lot size, however much lot size you want to use. You want to use a 1 lot, a standard lot, or you want to use a micro lot, or 0.5 lot, or 0.26 lot, 0. Whatever lot that you want to use. This is where you actually input it, even the smallest lot that we have right there, right, micro lot. So that is basically how you choose the lot size, right? You can even do this, like just adjust like lot size based on these buttons right here. So this is where you put the position size, and this is the currency pair that you are trading, and this right here, it shows you what type of order you want to actually enter for. Market execution means the moment you press the buy or sell button, you will automatically get into the trade, right? You will literally, your trade will be executed on the spot. However, if you want to have like a buy limit, sell limit, or buy stop, sell stop order, this is what it means, right? Let's just show you on the computer. So buy stop, sell stop is something like this, right? Something like this. So a buy stop is basically an order placed above price and price keeps going up. So if price is right here and you place a buy stop at this area right here, when price eventually get all the way up there, your buy stop will be triggered, and then your broker will automatically get you into the trade. And then a buy limit is basically, you want to place an order below where price currently is. So once price get below to that price, your broker will automatically get you into a buy position. And yeah, that's basically a buy limit. And a sell stop and sell limit is the same thing. It's just that in this time, instead of buying, you are selling. So sell stop is basically an order placed below price and price keeps going down. And sell limit is order placed above price and price then goes down. Alright, so back to the MetaTrader 4 tutorial that we have right here. So that's basically what it means, the buy limit, sell limit, buy stop, sell stop order.
Yeah, and then this is basically where you place your stop loss. Whatever price that you want to place your stop loss, you know, you can just put it right there, 1.085 or whatnot, 1.782, and then you can place your take profit, whatever you want to put here and stuff. And then once you're ready, place your stop loss, place the take profit, they'll press either the buy or the sell order. I'm just gonna maybe try out, give you like an example. So let's use like let's just put like a random as lot stop loss 1.08. 1.08, and then put like a take profit at like 1.09 and then place our buy. Yep, so that is basically how you actually execute a trade. And bam, you're inside the trade, you know, and then this is where it will show you this screen right here. This is your basically where you actually monitor your trades. After you execute your trades right here, you go here, then this is where you actually monitor your trades to see whether your trade is hitting your take profit or stop loss, how much money you are winning right now, how much money you are losing right now. So right now you can see this is like negative 0.05. This is a drawdown because of the spread fees, right? So if you click on the position, you can see the details of the position, the stop loss that you place, take profit, and yeah, the swap taxes, other stuff. And then if you want to modify the position, because maybe you place your stop loss wrongly, or maybe you place your take profit wrongly, or you want to take partial profits, right, and close half of the trade and let the other half run, just swipe and press this pencil button right here. This allows you to actually modify your trade, right? Modify your stop loss, you know, maybe you place your stop loss wrongly, modify it, and boom, modify, update it. And then if you want to close the trade, press this tick button right here. You can see this tick button, press on it, and you can see you can close the trade right here, right? You can close with loss. Yeah, basically if you press this button, it will close the trade. Right, before we do that, let's just show you some other stuff. Yeah, you can also add on to your existing position. Just press this plus button and you can actually enter for another trade on Euro USD as well. And then once again, this is the chart button, and this is the next thing that you want to look at. Before that, just a quick run through on this. The balance is basically how much money you have in your trading account right now. Equity is basically how much money you have in your trading account, your balance, plus your floating loss or profit. Right, and then margin, free margin, and margin level, all this other stuff, right? I will get through it inside another lesson. But basically, these are additional stuff that I personally don't really look. I mean, you don't really need to look at it, right? Basically, this is more on leverage and stuff, right? Which we'll run through soon. But these are all on leverage and stuff. But right now, you just need to understand that balance is basically how much money you have in your trading account, and equity is basically your balance plus your floating loss or profit, whatever that you have right here. And over here, this basically shows your floating loss and profit, right? So right now we are negative 0.08. So chart here, once again, chart, I believe there's nothing much to say about chart. It's pretty much quite similar to trading view. You can also add your tools right here. You can have a cursor here. You can add indicators here. You can add freaking lines here. Yeah, basically whatever you want to do, it's like quite similar to trading view. Yeah, you can see you can add a vertical line, right, and boom, yeah, you can just have fun with this. And then you can adjust the time frame, 5-minute time frame, 4 hour, 1 hour, so on and so forth. Yeah, so this is something like trading view. I personally don't like to look at the charts here because I don't really like the way that it looks. That is why I prefer to actually, you know, execute or rather analyze my charts on trading view itself. And then once I'm ready to place a trade, like a buy or sell order, then I go on to MetaTrader 4 and actually manually come in here and actually place that buy or sell order. That's it. I'm just going to be using this to execute my trades and monitor my trades. And I'm just going to be using my trading view to actually analyze my charts. So yeah, that's how you actually use MetaTrader 4. And yeah, that's the full tutorial on MetaTrader 4. And then once you close the trade, I forgot to mention, once you close this trade, whatever trade you close, you will come to this page history right here. And you can see the trade that you closed today, the trade that you closed in the past 1 week, and the trade that you closed in the past 1 month or so. Yeah, so yeah, this is basically a trade I just closed. You can see closed negative 0.04. And you can see the profit. You can see the if you withdraw money, you can see the withdrawal right here, and the other stuff that you can see right here, right? So balance, everything. So yeah, that's how you use MetaTrader 4. Very, very simple to use.
Today, I'm going to teach you how to become a successful trader who can bank consistent profits. My name is Brett Goh, and if you're wondering who the hell is this guy and why the hell should you trust this guy, here's what I've accomplished so far. I've been trading for 5 years and I've documented my entire trading journey on YouTube for you guys to see, or at least the past 3 years. So if you sort my videos back to the oldest, you will be able to see me live trading with less than $100 in my bank account, and just basically documenting my entire trading journey. And my why when I started trading 5 years ago was that I wanted to retire my father, right, who was 65-year-old and still working very hard to put food on the table. And I'm glad to say that I've accomplished that goal, that big why, strong, compelling why that allowed me to keep going this year, right? At the start of this year, I managed to retire him. So that will always be my proudest moment as a son. And then, like I said, I lost money for 2-3 years. So yeah, I'm going to be honest and transparent with you and tell you that I lost money, right? I didn't came out of my mom's womb and just became a profitable trader who is smart and intelligent. I was a dumbass. I made a bunch of mistakes. I lost over $10,000 in one day. I lost the school fees that my dad actually paid me. And I lost my life savings. Okay, I'm a dumbass, alright? So yeah, it might help for you to actually gain somewhat like a relatability to me, like you can relate to me that you're a dumbass, I'm a dumbass as well. So I've been losing money for 2-3 years, and that's before I finally got like my breakthrough moment, my eureka moment where I made over $100,000, 6 figures annual income, right? So this happened about in my third and fourth year, right? 100K. So it also I made $1 million at the age of 21, right? This might seem like somewhat of like a proof or somewhat of like a flex to you guys, but by no means am I flexing to you guys. For me, I have to get matured and become successful at a young age so that I could really provide my family with a better quality of life. Now my dad is traveling anywhere he wants. My mom is sitting at the back of Mercedes-Benz S-Class. So $1 million at the age of 21, pretty impressive. And then most thing, like I feel like one thing that I'm genuinely proud and passionate about is this: 2,000 plus happy students. Right? So I've coached over 2,000 plus students by now, right? And every single one of them are happy, they are successful, or rather they are making progress towards success and they've achieved results. Recently, I've interviewed some of my top students, Alia who made over $25,000, somebody who made over $10,000, and Carl who made another $20,000 from his funded account, right? So yeah, it's crazy. These students are really crazy. Their success is my success. And I've built the fastest growing trading brand in the industry, right? So if you look at my YouTube channel, just scroll down, you'll see that I'm near 1 million subscribers right now. Something that I'm very proud of because I built that shit brick by brick. And that's only because I was able to simplify a complicated trading concepts that is so complex and stuff, so difficult to understand. I'm able to simplify them into a way that a 5-year-old can understand, right? That is the main thing. That's the main reason why my channel blew up, right? And it's not because I'm the funniest guy. I'm not gonna lie, I'm a boring ass guy. And it's not because I have the flashiest lifestyle. It's all because of the fact that I'm able to provide tremendous amount of value, which is what I hope to do in this video. Last but not least, if it helps, I've got nothing to sell you. Alright, I've got nothing to sell you here, right? By the way, I hate those people who flex a lifestyle, they flex their cars, their chains, their mansion, in order to bait you into buying a course, right? I'm not the type of guru. What I am is a guy who's able to do everything he can to provide value for free and also to make sure that you guys learn what you need in order to become successful. So I've got nothing to sell you here, right? I do have like an education company, 1% Club, but like I said, I'm not here to promote it whatsoever, right? In fact, I'm going to close the enrollment soon because, yeah, we just don't want too many customers. We want to focus on our current students. All right, next. Here's basically proof that, I know what I'm talking about. I know something about making money, right? Or I know something about trading, right? And I've made this amount of money from trading. So at least I'm probably like one step ahead of you. I wouldn't say that I'm like 10 steps ahead of you. I'm a millionaire trader. No, because that's not the truth. The truth is I'm probably just one step ahead of you. I've pretty much just like figured some things out that you haven't figured it out yet. So yeah, I just hope to shorten your learning curve inside this video, right? So what is the big promise for this video? The big promise for this video is that I'm going to show you how I went from $0 to making my first $100,000. I'm going to tell you everything, a step-by-step blueprint on how I went from $0 to making my first 100K from trading. As long as you have the patience, you have the attention span to watch this entire video, this journey that you're going to go through, I can shorten it from 3 years to say 1 year, right? If you genuinely learn everything inside this video and you apply what you've learned and you go out there and practice with enough time, you're going to reach this amount. Trust me, it's 100% possible. If such a dumb-ass Asian guy wearing this ugly-ass spectacles can do it, you can do it too, right? You can do it. So I'm going to dissect this entire process into 3 core components, right? 3 core components. The first one is strategy, right? So strategy, if you have a good and successful strategy, this journey is going to be much more easier for you. Second thing is funding, right? Obviously, you need money in order to make money in trading, right? So you need to learn how to raise enough capital in order to reach this level, because it's very hard to reach 100K if you only have $100 in your bank account, right? Just like what I did when I started. And then last thing is something that is kind of cringe. Heart or mindset, right? A lot of people don't like this stuff, but this stuff is the most important stuff ever, right? If you have this can pretty much outweigh all of this stuff right here. All right, so yeah, without further ado, let's just dive straight into it. So let's talk about the first stuff, which is the strategy. I believe that you guys love this part, right? Strategy. And in this video, there won't be any charts whatsoever. If you go to my YouTube channel, you will see there's a ton of chart videos. So the truth is, you don't need any more chart videos. What you need is some real cold, hard, pure wisdom from the trading geek himself. Right, so first, let's talk about strategy. Okay, strategy. Now, what do you know about strategy? You probably know that there's a ton of trading strategies out there, right? And just to name some right off the top of my head, you got price action, you got smart money concepts, you got ICT concepts, you got, I don't know, indicators, right? RSI, Bollinger Bands, MACD, lots of strategy out there. The question becomes, which one is the best and which one do you pick? My advice is always going to be so simple. Pick one. It doesn't matter which one you pick. You can become successful using any of these strategies here. We got successful price action traders, right? You got billionaire trading price action. You got smart money concepts traders who are banking a lot of money, taking high risk to reward trades. You got ICT concept traders who is absolutely killing the markets, right? And then you got people using indicators. Look at my face. I hate indicators. I'll always judge you if you use indicators. But we got people using indicators and still making money. Yeah, so even though I hate indicators, people are still making money using this stuff thing. So my advice would be stick one and go and master them. The last thing you want to do is to become a jack of all trades and a master of none, right? What you want to do is to be extremely good, extremely proficient at one thing and one strategy only. So pick one and go and master them. Now, if you're wondering which one is the one that I trade, before I erase this, what I trade is what I call market mechanics. Okay, market mechanics. Now, this is a combination of the most profitable parts of smart money concepts, ICT concepts, and price action. So for me, I trade all of this, but what I did was that I dissected, or rather I researched, and I did a lot of testing on this to find out what is like the most profitable part of these strategies, and I combined them together to form market mechanics. And this is something that's unorthodox and has never been done before. But yeah, so that's what I did. And right now, market mechanics is a trading strategy that is going to get me to making 7 figures from trading. Yeah, because right now I've only made 6 figures from trading. In order for me to get to 7 figures, I needed to deploy market mechanics. So let's talk a little bit about market mechanics on why it's so profitable and why it's so useful. All right. So let's say you do decide to go to the market mechanics route. There's an entire playlist of free courses on market mechanics on my YouTube channel. You can just go to my YouTube channel, go to market mechanics playlist. You can see the entire playlist of free courses, right? So before you do that, let me just quickly explain to you what is market mechanics and why is it so good, right? So now, what the heck is market mechanics, right? This is something that's out of the box. Market mechanics. This is essentially how the market operates. If you can really understand how the market operates, how and why price move on a deep fundamental level, you can print money. I'm not even joking right now. You can print money. Imagine you are able to trade alongside the smart money who move the market. Imagine you are able to go onto a blank chart and know exactly where the market is doing, what the market is doing right now, who is in control of price, supply or demand, and where is it going to go next. That is the power of market mechanics. And what does it constitute of? Right? So a strategy like market mechanics, it constitutes of a few core components. Firstly is your supply and demand, right? Supply and demand, this is where we identify certain point of interest, okay, that institutions have trade or rather enter large amount of orders, right? Like example, this is the demand area, and now we are expecting price to come back down to this demand area, right? Because this is the price that they enter a large amount of order right here, right? They enter a lot of buy order, and now we are expecting price to pull back to this area, and that is when we can get our entry again, because this is the price point where they are going to enter again. So supply and demand, and then next is order blocks, right? So order blocks is a little bit like supply and demand, except that rather than just large bulk of orders, we are identifying like large amount of candlesticks like this, right? A lot of imbalance in price, right? A lot of orders being filled up at a short period of time. And that we have our order block, right? Which is like right here, right? This is the candlestick before the imbalance. And now same thing as supply and demand. You're just waiting for price to pull back, fill up all the imbalance right here, fill up all the orders right here, and then watch price move up. So these are two things. This is basically how we actually identify the point of interest that we want to trade from using this market mechanics strategy. And the next is liquidity, right? It is extremely important to understand liquidity, because liquidity is essentially how and why price move, right? If you can understand liquidity, you will not get stopped out so often. That means you will not lose money, and that means you will not get your trades, sitting your stop loss getting hit every single time. That's because you understand liquidity. Because if you can understand liquidity, then you will not become the liquidity itself. So yeah, liquidity is available above every swing high and below every swing low. And obviously there's a lot of like things about liquidity I'm not going to talk about in this video. Like I said, I've made an entire course on each one of these concepts right here, which you can find inside the free market mechanics playlist. And then next, it's also, I believe the one last thing is liquidity, supply and demand, order blocks. Is it inducements? No. Is this it? Inducements? Yeah, inducements is actually part of liquidity. It's basically like traps set by institutional traders, right? Traps set by institutional traders to actually bait retail traders to enter for the setup. Example, when you see this double top, right? A lot of retail traders think that, okay, this means that they should enter for a sell. And then next thing you know, they enter for a sell here, smart money push the price up, stop out all the retail traders, and then push price down. Inducements. And I just realized inducement is just a part of liquidity. Whoa! Market structure. How can I forget about this? Market structure is king, guys. Yeah, market structure is king. Market structure is basically essentially how the price move, right? In an uptrend or in a downtrend or in a consolidation. The ability to identify what phase of the market is it in. Is it the push phase or is it the pullback phase? Is it the consolidation phase? Is it the trending phase? This allows us to know exactly which phase of the market is in right now, and then we can trade accordingly. And the last thing is order flow. Now, the last thing is order flow. This is basically where we dive deep into looking at how, or rather who is in control of price, whether the buyers or the sellers. And we do that by looking at footprint charts, and we do that by looking at what price is doing. Is it in the demand range, supply range? Yeah, and who is really in control of price. That's the main thing of order flow, right? So these are the 5 core components of market mechanics, and this is basically how I trade, right? Like I said, I've already made a video on each one of these concepts, which you can find in the free playlist. Yeah, so anyways, market mechanics. And then, okay, inducement is part of liquidity. I'm not a dumbass for actually writing this down. Yeah, right now I'm experiencing a little bit of brain fog. So, yeah, just hit a heaviest gym workout, So yeah, that's for strategy, right? So now that you have figured out, okay, what strategy you want to trade, and you have picked one to actually go and master, what is the next step, right? Okay, the next step is obviously to learn everything you can about that strategy. Example, if you want to learn about market mechanics, go and watch the market mechanics playlist that I have on my YouTube channel. Like this entire playlist of like around in-depth, like I think 8 videos, in-depth video on each one of these concepts. Yeah, you will definitely master trading, and you don't even need to buy a course whatsoever. You can learn it for free on my YouTube channel. And that is for market mechanics. Oh yeah, basically after you're done with learning all that stuff, right? Next step is to practice, obviously, right? You have learned, you have practiced, but how do you actually know that this strategy actually works? That's the main thing that you need to do. And that is what I call testing. Right? So, after you have formed a trading strategy, you need to make sure that you can prove that the trading strategy actually works. Because if you don't, you will always be doubting yourself and your trading ability.
when you go onto the market, you will not be able to enter for the buy or sell button because you don't build that confidence yet. You don't have confidence in your trading strategy yet. And where do you build this confidence? Confidence comes from competence, right? And you're only able to build confidence in your trading plan if you have tested it out, right? So this is the key thing here. You gotta test your trading strategy out. There's 3 types of testing that you can do, and that's what I call back testing. Okay, back testing. And then another thing is what I call forward testing. And then the last thing is what I call chart exercises. Now, this allows you to know whether your trading plan actually has an edge or not. So you backtest the trading strategy. By the way, you should do all of this for at least 1 month before you trade on a live account. Okay, at least 1 month. Go and backtest the trading strategy. So how you backtest is that you basically go to TradingView, you bar replay, right? You test out your trading strategy on historical price data, right? And then how you forward test is basically every single day you mark up your charts, right? You mark up your charts with the trading strategy, and then you basically trade on a demo account, or you just see whether your markups actually work. You know, you mark up your chart and you think that, okay, price is going to go up now. So the next day you check your charts again, see if price actually did go up. If it go up, then yeah, that's one win for you, right? So that's how you forward test. And then for back test is basically you test out your trading strategy based on historical price data. And chart exercises is pretty much you testing, or rather you marking up your charts on TradingView itself and then just seeing whether it's correct or not. So that's for testing, right? You need to spend at least 1 month doing this. I don't want you guys to go and trade your trading strategy on a live account, right? Very, very important here. A lot of you, what happened is that you come into trading with this mindset where you want to get rich as fast as possible. So what you do is that, okay, you have find your trading strategy, right? You have watched a bunch of trading videos, be it my videos or some other trading guru videos, and you found that, okay, this guy is driving a Lamborghini and his trading strategy is obviously going to work and it's free on YouTube. So I'm going to copy it and I'm going to put it on my live account. I'm going to test it out on my hard-earned money. Guys, how stupid is that? How stupid is that? Yeah, so you must test out the strategy first, right? To see whether it works. And if it does, then use it on a live account. If not, switch to another strategy, or rather refine your strategy until it works. So that's a very important thing, and I believe that's a process that most beginners skip, right? Because all of them, they just want to go straight from $0 to making, what, 10K per month, right? And they just skip the process between. And don't get me wrong, you can easily skip the process and still get the 10K per month, which means you don't have to test out your trading strategy. You can use the trading strategy and immediately you can get to 10K per month. Trust me, this is possible. But the thing is, are you able to maintain this 10K per month? Are you able to keep the profits that you have made? Because in trading, it's not about how much money you can make. It's about how much money you can keep. That's the main thing, right? So yeah, please go and test it out. And yeah, by the way, when I talk about trading strategy, I mean things like you need to take into account your risk management, right? Your risk management, right? How you actually manage your capital. And then I'm also talking about things like your entries. Okay, where do you enter for the trade, right? Where do you enter so that you can get like the lowest risk and the highest reward? And then where do you get out of the trades, right? And also things like your trading session, what time are you trading? And also what currency pairs are you trading? All of this stuff needs to be inside your trading plan, needs to be part of your trading strategy for it to actually works. So just quickly, just think of all of this. Once again, I already did a video on how to actually do all of this, right? How to actually map out your mechanical trading plan. But yeah, that's for strategy, right? So like I said, the first thing you want to actually have is a profitable trading strategy. Because when you have a profitable trading strategy, guess what? Your trading journey is going to be so much more easier because you already have a strategy that is proven to work, that has already been back tested and forward tested. And now you have confidence in your trading strategy because you actually have trading data to back it up, right? So obviously you're going to be confident. Next is what I want to talk about, and that is funding. Now, in order to make 100K, in order to make 10K per month even, in order to make, let's say, $5,000 per month, you need funding, okay? You need funding, buddy. What this means is that right now, if you're a beginner, you probably only have like less than $1,000 in your bank account or something. Yeah. and you cannot afford to trade more than 10K, right? Let's say right now you can only trade 10K. Okay, so, oh my god, there's a magic button, magic pocket right here. Oh, wrong color, magic pocket. So let's say right now you have 10K in your bank account or your trading account. Know that you can only make, let's say, $1,000 per month from trading with 10K. $1,000 per month. That's the most that you can make. If you are following proper risk management rules, like, risking 1% and all that stuff, the max is $1,000 per month, right? You cannot make more than that. So in order to make 100K, right? Oh no, right here. In order to make 100K per year, right? Let's just do the math a little bit. 100K per year, that's at least like 10K per month, okay? Let's be a little bit conservative and just set it at 10K per month. So in order to make 100K per year, you need to make 10K per month. How do you make 10K per month? If you are only trading with $10,000. That means you have to flip your 10K to 10K and to 20K, I mean. And that's going to be very hard to sustain. I can guarantee you that if you try to flip your 10K to 20K, you cannot do that consistently. You cannot do that every single month. You cannot flip 20K to 40K and then 40K to 80K and then 100K. It's not that simple, right? Even though you have like a profitable trading strategy and by right, you are just going to win every trade. No, that's not how it works. Because trading is a probability game, right? It is a probability game where there's going to be a random distribution of wins and losses. So even though you have a profitable trading strategy, you are not going to win every single trade. You will still lose some trades and you need to take into account of the losses, right? So in order to make 10K per month, I'll say a minimum amount of trading capital that you need to have is 100K. You need at least 100K to make 10K per month. And $10,000 of 100K is just 10%. Right? So in order to make 10K per month, you need to make a return of 10% every single month. And I can tell you that is also quite difficult already. Right? This is actually quite difficult. So to be even more conservative, by right, you should have 200K in trading capital in order to make 10K per month. Right? But let's say, you are a genius or rather you are better than the rest. You are able to make 10K per month. So let's talk about how to get this in funding. How do you get 100K even though you only have less than $1,000 in a bank account, less than 10K? You do that through prop firms, right? So prop firms are basically companies which offers you funding, and if you make a profit, they take a certain amount of profit, right? So there's a lot of prop firms out there, right? So there's a lot of prop firms out there. There is things like your FTMO, Alpha Capital Group, and then there's Funded Next. There's a lot of prop firms out there. I'm not going to tell you which prop firm to use because I'm not going to promote them or whatsoever. But what I would advise you to do is to just stick with FTMO because this is the one that is the most trusted, the most reliable, and most reputable. The others, I wouldn't say much about them because yeah, this is just the best one. So if you had to choose one, I'll advise you to stick with FTMO. But FTMO is harder than the rest because you need to have it's going to be harder to pass the evaluation phase and the verification phase because you have like a higher target to actually aim for, right? But anyways, most trusted, most reputable, always go to FTMO. Now that you have, know exactly which prop firm that you want to use and you want to purchase like a 100K account, right? But like I said, do not do this straight away. You should have tested out your trading plan. You should have tested out your trading strategy and has some sort of proof that you have an edge. Because the last thing you want to do is to go immediately get a 100K account and you don't really know how to manage risk properly and you end up breaking the rules and you lose the account and you lose the fee that you had to pay in order to get this account, right? So that's not the mindset to have. So like I said, I will advise you to only even get funded account like after 6 months of trading, at least 6 months. And it's very important that you actually test out your trading strategy. So 100K, let's say you want to make 100K from trading. Oh no, let's say you want to make 10K per month, right? So we are getting 100K to make 10K per month so that we can actually make 100K a year. Now, from this 100K, in order to even get this 100K, you have to pass through phase 1, and then phase 2, and then eventually then you get that 100K, right? After you pass through these 2 phases, right? And I'm not going to talk too much about the details on like the phases, the maximum drawdown, the profit target that you need to actually aim for in order to pass each of these phases, you can find them on the website itself. But what I'm going to do is that I'm just going to quickly give you like a quick strategy on how to manage your risk using this 100K. How do you manage this trading capital? Very simple, okay? Very, very simple. So let's say start off with 100K, okay? Let's erase all of that. Now it's time to do some math, ladies and gents, right? Because like I said, what you need is a very clear-cut plan in order to get to 10K per month. Okay, so let's say right now, today you have 100K in your trading capital. This is your initial account balance. This is the money that you start with. And your profit target is, let's say, 110K because you go to FTMO. So you need to make 10%. Okay? You need to make 10% in order to pass phase 1. Okay, that's for phase 1. Right? So, yeah, so your job is to make this 10%. How do you make 10% in 1 month? This is where my funding blueprint come in, right? This is the blueprint that I've actually discussed with my coach, and my coach has already given it to me. Or rather, no, not my coach. One of my colleagues inside 1% Club, and he's also coaching the students, right? So yeah, so this is a plan that he has been using to pass funding challenges, and it's also the plan that is really useful, right? I found that it's really useful. So I'm just going to share it with you guys for absolutely free. So start with 100K. So let's say you win a trade and you grow it to 100. Okay, let's assume that every single time you take a trade, you are risking 1% on each trade. Right? You're risking 1% on each trade. That means you are risking $1,000 on each trade. And assuming that your minimum risk to reward ratio is 1:3, because that's the one that you should aim for, right? 1:3 risk to reward ratio. That means if you risk 1%, you will make back 3% in return. All right? A standard risk to reward ratio that you should all aim for. So if you are able to win the first trade, this 100K just became 103K. And then let's say you win the next trade. This 103K just become 106K. And then let's say you're still so lucky, you win another trade and you just turn this into 109K. And right now you're just $1,000 away from that goal, right? Which you can easily attain. This is if you are lucky enough to win 3 trades in a row, right? But obviously, this is not going to happen all the time, right? You must either have like a really good trading strategy, like a very high win rate, or you're somewhat lucky. Let's be honest, luck is going to play a part right here, right? Because like I said, trading is random. Okay, now, let's say if you lose. What happens if you lose? This is if you win. This is the best case scenario. What is the worst case scenario? Okay, this is where the strategy come in. The worst case scenario is that you lose 1%. Okay, you lose 1% and now you're back to 99K. You lose another 1%. Okay, you lose 2 trades already. Now you're back to 98K. Now, after your account dropped to 98K, right, and you already lose 2%, what I want you to do is to change this risk per trade, this 1% per trade, change it to 0.5% per trade. So instead of risking 1% on each trade, you're only going to risk 0.5% on each trade right now until you're able to get your account balance back to 100K. And then from 100K onwards, you can continue risking 1% per trade until you reach 110K. So that is the key strategy here in terms of passing your funding challenges, right? So let's say you lose another, so you already 98K, right? Then you start to risk 0.5% per trade. So you lose another trade and you are down to 97.5K. And then you lose another trade and then you're down to 97K. Now, obviously, you're not going to lose like so many trades in a row. At some point of time, you're going to start winning. And when you start winning, what happens? You make 0.5 times 3, that's about 1.5%. So that is when, if you continue your 1:3 risk to reward ratio, you make 1.5%, you're able to bump up from here to 98.5K, and then slowly get back to this break even. Once you're back to your initial account balance, just continue doing the 1%. Change this back to risking 1% on each trade. And you do this until you reach 110K. You just risk 1% per trade and you get a 1:3, so you just need to win about 3 trades, right? So in this case, in this strategy, right, you can see how you lost like 4 trades in a row. And then you win 3 trades. Or then no, 3 trades. 3 trades minimum, because you still have 1 more percent, right? So I'll say 3 to 4 trades. You win 3 trades, you lose 3 to 4 trades, and you just complete your phase 1. You just made 10%.
And that is how you make 10K per month from trading, right? By using this strategy. And I understand that it might get a little bit confusing. So what I want you to do is that if you're unclear on this strategy, go and rewatch this part, right? Rewatch over and over again, take down notes and just test it out, right? Because trust me, this is a strategy that has gotten a lot of our students at 1% Club funded. And yeah, it's a strategy that my one of the coach inside the 1% Club used to actually got multiple 5-figure payouts. So yeah, I can tell you that this actually works. So that's for funding, right? So that is basically how you achieve the funds in order to make 10K per month and in order to make 100K per year. Like I said, that is 10% per month, right? That is actually quite difficult to actually make. So the more amount of money that you have in your trading capital, the easier it will be for you to make, say, 10K per month or 100K per year, right? So I'll advise you to go for like a 200K account, right? That's more conservative when it comes to making 10K per year. I mean, 10K per month, because in that case, you only need to make about 5% per month instead of 10%, right? So that is for funding. Last thing I want to talk about, let me just find my green freaking marker. Freaking hell, I got one of the colors except for green. Okay, the last thing I'll talk about is the most important thing ever. And I know you're about to fall asleep right now, so get out on your feet and shake your hands and shake your belly or something and just slap yourself in the face and pay attention to what I'm about to say for the next few minutes or so, right? Like I said, I'm going to wrap it up very, very fast. This is about to end soon. So please don't fall asleep and listen to this. This is the most important thing ever. And that is your mindset. Now, Brad, why are you talking about mindset? Mindset, this is a trading video. Bro, this is what separates the bottom 99% of traders from the top 1%. If you can master this one thing, you will not just be able to bank consistent profits. You will be able to sustain in this game for the long term, right? That means that you are able to actually trade for the long term. 3 years, 5 years, however long you want to trade, you can do that if you have a solid trading mindset. So let's talk about that. How do you develop a proper trading mindset? Or rather, how do you achieve your goals? First things first. First thing I want to talk about, okay, in this mindset training, I'm not going to talk about things like your trading psychology lesson that you've probably heard over and over again, like, if you are greedy, do this. If you are feeling FOMO, do this. Take some time off the charts, learn about trading psychology. I'm not going to talk about all those basic trading psychology advice. I'm going to talk about something that works, something that will actually allow you to open your eyes. And that is belief. Belief. Belief is the most important thing when it comes to achieving success. If you don't believe that you can succeed, what you will do is that you will not take the actions that will actually allow you to become successful. If you believe that you can become successful, you are automatically going to be taking the actions that is aligned with your goals, that's going to push you closer towards your goals and achieve success. So belief is the most important thing. And if you don't believe me, here's why belief is so important. Belief, when you believe something, you're going to do things that is in accordance with the belief, right? So that is going to lead to actions, okay? So example, I believe that trading is difficult. So things that I'll do is that, okay, since trading is so difficult, I'm not going to bother study trading. Or even if I do study trading, I'm just going to half-ass it because it's difficult and it's literally designed for me to fail. So why bother working so hard on trading? Belief, actions. Or I believe that risk management is pointless, right? Risk management is pointless, it's useless. Why would you need to manage risk if you can just have a good trading strategy? You just need a good trading strategy. As a result, what happens next is that you don't use a position size calculator, you don't manage your capital properly, and you end up taking a bunch of stupid trades, take big losses, and you quit trading because you just lost your entire life savings. Belief lead to action. You can see how important this is, and your actions actually leads to your reality, right? So understand that your current situation in life right now or in trading is the result of all the decision, all the actions that you have taken. So you are 100% responsible of your life, your current situation right now. That means if you can change your belief, you can change your thoughts, you can change your actions, you can change your reality. This is something that not a single trading guru talk about. And I can tell you that this is the thing that is going to make my students unmatched. This is the things that is going to take my students who learn this become millionaires. I know for a fact that this will actually create millionaires if you can really understand this loop, right? But the thing about changing your belief is hard because how a belief was formed in the first place, it's based on your experiences, right? So imagine there's a scale right here. Okay, there's a scale, and then there's a bucket right here, and this is a green bucket, and then this is, let's say, a red bucket, right? So this is the bucket of positive experiences, and this is the bucket of negative experiences. Okay, so positive experience bucket and negative experience bucket. Every time you encounter a negative experience about something, you're adding more weight into the negative bucket. So this scale will start tipping to the negative experience. And when this happens, what you are doing is that you are forming a weak belief on that thing, right? So example, let's say this is a scale on belief on how difficult trading is, right? This is a scale on, that is your belief on how difficult trading is. So example would be, you start hearing your friends telling you that, Brad, you can't do it, man. Like, trading is difficult. You know, only 1% of the people become successful. Or trading is a scam. It's only for those people who graduate from finance with fancy finance degrees and they work on Wall Street. Only they can become successful. You can't do it. So you hear your friends saying this. What happens is that you are adding water, adding weight into the negative experience bucket. And when you do that, what happens? The scale tips towards the negativity and you start thinking that trading is difficult. It is difficult. And what happens next is that your mind, it will seek evidence to reaffirm that belief. It's going to do everything it can to reaffirm this belief that trading is difficult. So that's the first experience that you encounter, the first negative experience. And now when you believe that trading is difficult, next thing you know, you pull up to the charts, you enter for a trade anyhow, right? You don't have a plan whatsoever, just anyhow, just press the buy or sell button and you lose the trade. When you lose the trade, what happens? Now, you reaffirm this belief and you're adding more negative experience into the bucket. Now you really believe that, I just lost a trade. Is trading really difficult like what they say? Maybe I just suck at trading. Maybe I'm not born for trading. As a result, more negative experience. And you can see this scale just keep on tipping in the negative scale favor. And you will always have the belief that trading is difficult and you will eventually lose money and quit trading. This is the stuff that nobody talk about. I can guarantee you, if you're watching this far, it's already 14 minutes in, and you're still watching this, you deserve to know this. Because this is something that literally nobody talks about. And how you tip this scale back in the favor of the positive experience so that you can actually believe that, okay, trading is easy, it's doable, anybody can master trading as long as they put in the effort, they put in the time. They show up every single day, regardless of how they feel, show up to the best, and come hell or high water, they're going to do everything they can to achieve their trading goals. Boom, that's how you tip the scale to your favor. So how you tip the scale to your favor and really change that belief, it's by adding more positive experiences. Okay, here's the cool part, right? The thing about your mind is that it cannot differentiate what happens in your mind and what happens in reality. It cannot differentiate whatsoever. This is the cool part. This is the secret here, guys. So listen up. So this means when you have a nightmare, just think about the times that you have a nightmare and you woke up and then you start feeling your heart pumping very, very fast. Your palms are sweaty. This is because your mind perceives that nightmare as a real life event that you have encountered in the physical world. It does not know that it's just happening in your mind. It thinks that it is a physical real life event. What this means for you is that what you can do is to create positive experiences in your mind, right? Add these positive experiences in your mind in order to shift that belief about trading. And when you do that, what you're essentially doing right here is that you're just adding a bunch of positive experiences to strengthen your belief that you can succeed at trading. Trading is easy. Risk management is useful, right? You can really use this to fix any problem that you encounter in trading. Be it the false belief that you have of trading psychology is useless, this mindset training is a bunch of bullshit. You can shift your belief back by doing this. And like I said, you can add positive experiences by using your mind. And what you can do is to
visualize, right? Oh, visualization again is a bunch of bullcrap. No, let me tell you why visualization works. Because like I said earlier, your mind cannot tell the difference between what happens in your mind, like a visualization or a memory in the past, then compared to something that happened in real life. That means you can think of a past memory, or you can think about a future thought or a visualization. Your mind is going to think that that's the same thing as what happened in real life. That's why when you think about your fear, like just close your eyes right now and think about something that you are genuinely scared of. Is it spiders or ghosts or I don't know, like something random, something that you are scared of? You'll start to feel your palms start getting a little bit sweaty, and you start to feel a little bit anxious. This is why this is so important. Your mind literally can't differentiate the difference between your past thought, visualization, or what happened in real life. So what I can do is visualize. When you visualize, your mind and body thinks that has already happened, right? This is your current reality, and this allows you to add more positive experiences inside the bucket. Example, you visualize trading is easy. You visualize yourself seeing MetaTrader 4 profits on your screen. You visualize yourself going to the charts and just executing a trade without any hesitation whatsoever. You visualize yourself marking up the charts within 10 minutes. When you do that, once again, what are you doing? You are adding positive experiences inside the positive mark bucket, and as a result, this scale is going to tip in favor of the positive experience bucket. So you're going to develop the belief that trading is easy. Trading is easy, right? Trading is actually simple, right? And when that happens, what happens next? When you have that strong belief that trading is easy, it goes to your mind. And then it results in you taking actions in accordance with your belief that trading is easy. You're going to start that, okay, trading is easy, so I'm just going to practice, show up every single day, do my best, right? Every single day, come hell or high water, I'm going to do everything I can to achieve my goals because it is possible. I'm going to create my trading plan. I'm going to study the trading videos. I'm going to practice on the charts. I'm going to do my back testing. I'm going to jump my trades. And when this happens, what you are doing is that you are getting better as a trader. You are improving as a trader. And when you improve as a trader, obviously, money comes as a byproduct, and this results in you having the reality that you desire, or by changing your belief. And you do that by having some sort of positive visualization, right? So this is not to say that, oh, all you need to do is to sit there and say, oh, I'm going to become a successful trader, I'm going to become a millionaire, and automatically that will happen. Like your bank account will just have $1 million inside the bank balance the next day after you just visualize. No, that's not how it works. Obviously, visualize, but you need to put in the work. You need to do the actions that is actually required in order to achieve your goals, in order to achieve your desired reality. That is why this part is as important as this part. You need both. You need good belief that result in great actions for you to achieve the goals that you want to achieve, be it 100K per year or 10K per month. And if you can really master this formula, you can make more than 100K per year. You can make more than millions of dollars. You can genuinely bend reality to your will. And let me tell you something. This is what most highly successful people do. Right? That's how they achieve so much success. That's how they make billions and millions of dollars. And it's all through this formula. This is the most important lesson you have to watch in the entire course. Because what separates professional traders who win consistently from beginner amateur traders who lose is the ability to trade based on clear defined rules. Basically, having a mechanical trading plan. So, in this lesson, we're going to go deep dive into building a mechanical trading plan that is not only profitable, but is actually tailored to your trading style, your trading personality, and basically your trading journey. So, quite frankly, if you are still losing money as a trader, you either don't have a mechanical trading plan, or you have one, but you are just not following it consistently. Or the third reason could be you just have a lousy one. So in this lesson, like I said, I'm going to go through how you guys can actually build a profitable one so that you can actually make money consistently. So this is basically how the majority actually trades, right? They are hesitate
to take a good trade setup, because you just went through a losing streak. Your confidence is low, you're starting to doubt your trading ability, then you end up skipping a good trade setup, only to see it go in your way. When this happens, you start regretting not taking the setup. Oh, I should have entered for this trade. I knew it. I knew this would happen. After it has already played out successfully. Now, when you do this, you are basically what I call a hindsight trader, right? Oh, I should have done this. Oh, I should have entered for this trade. Oh my god, I knew this would happen. But guess what? I was too stupid to not actually enter into the trade. Hindsight trading. And then this actually leads you into rushing into a bad trade. And you start forcing trades even though there's no trading opportunity. Because you feel like trading. Because you just missed a good trade setup. And you start to think to yourself, you know what? Let me just go into the next trade without really like thinking through it. Because I already missed a good trade setup. I don't really want to miss another good trade setup. But then, make no mistakes, that is actually a bad trade setup because it's low quality, it's not based or rather aligned to your plan. And then you don't hold a trade to your take profit because you are afraid to lose your current profits. And then you succumb to emotions when you are trading because once again, you do not have clear defined rules. And as a result, you don't know exactly what you are looking for every single day. Now, this form of trading is called discretionary trading, where you are relying on your subjective judgment or gut feeling and the current market conditions to trade. So basically, you enter trades based on how you feel, right? You enter when you feel like it. You get out of the trade when you feel like, maybe the trade is not going to play out. You trade basically based on how you feel and your intuition. Once again, you will not make money consistently if you are always succumbing to your emotions when you are trading. Because you will always end up missing good trade setups and just wasting your hard-earned money, your precious capital on just bad trade ideas. Now, once again, this is some characteristics for discretionary trading. Basically, you are relying on emotions and your gut feeling. And this actually allows you to take bad and low quality trade setups which really don't work at all. It's really not profitable. It's not going to make you any money whatsoever. And the thing is, it's very difficult for you to backtest and journal your trades when you are trading based on your emotions and you don't have like a clear defined trading approach. Because today you are trading this strategy, tomorrow you are trading this other strategy, and then the next day you are trading based on what you are feeling on that day. Oh, I feel like lucky today. I feel bullish today, so I'm going to enter for a buy. It's very hard to track your data in this way. And if you can't measure your trading performance, how are you going to improve your trading performance? How are you going to refine your edge? It's impossible for you to do so because in the first place, you are just trading randomly with 10,000 different trading strategies. So once again, do not do this. Do not be a discretionary trader. So the solution to this is another form of trading called your mechanical trading. Now, this is how the top 10% of traders are able to make money consistently. This is where you rely on a trading system to decide which trades to take, regardless of the market conditions or your emotions, right? So in this case, you are able to identify high probability setups. Because once again, you are following, or rather you are trading based on mechanical rules that's on paper. So if the market does this, you enter for the trade. If the market does not do this, you don't enter for the trade. You stay out of the market. Once again, a very, very clear rules-based approach. And it's much more easier to actually backtest and journal and track your data in this way. Because now you are able to record your trades in a way where, okay, if A happens, I'm going to enter for the trade. If B happens, I'm not going to enter for the trade. Now, when this happens, you are entering and exiting the trade the same way every single time. And this really allows you to find out what are your flaws in your trading strategy so they can improve on it. And this really, like I said, it allows that continuous refinement and improvement where you are able to continuously get better as a trader and as a result, make more money. Now, when you go onto the market, or rather when the market opens, there's going to be thousands of decisions that you have to make in order to execute a trade properly. For example, where should you buy or sell? What price point is ideal for entry? Where you enter a limit order or a market order? How do you manage your open position? Where are you trailing your stop loss? How are you taking your partial profits? You see, there's all sorts of questions flooding your mind as you see the candlestick starting to play out. And when this happens, it's gonna be very confusing for you. And this increases the chances of you trading based on your emotion, based on your gut feeling alone. If you have clear defined rules in place for every single decision you have to make when you are trading, it will reduce the chances of you trading based on your emotions. In this way, the trading system decides which trades that you should take, regardless of how you feel or the current market conditions. Once again, just to make this clear, mechanical trading strategy will not completely get rid of your losses, meaning you will still lose money. But now, when you trade mechanically, you will suffer good losses because you are only taking trades that is aligned with your plan, right? And this way, you are able to treat these losses as business expenses because you follow your plan and the trade end up still didn't go in your way because trading is a probability game and the market is random. It is what it is. Move on to the next trade. Once again, when you are trading mechanically, you accept the fact that trading is a probability game and anything can happen in the markets. Now, this is a path, or rather a very dangerous path, a downward spiral that majority of traders tend to fall into, right? This is somewhat like a trap. Firstly, you trade based on your emotions, based on your gut feeling. So this is your discretionary trading strategy. When this happens, right, like I said, you trade based on emotions, you tend to take stupid trades, right? As the quote says, play stupid games, win stupid prizes. So you end up losing trades. Okay, when you lose trades, guess what? Your confidence drops. You start to doubt yourself. You start to doubt, does trading actually works? Like, can trading actually makes me money? Can I actually get rich from trading? And then this actually causes you to miss trade setups because when you're doubting yourself, your confidence is low. You're thinking, the chart is showing me this. I should enter for the trade. But guess what? Nah, I'm not gonna enter for the trade because I just went through a losing streak and I suck at trading. No, right? Then you end up missing the trade. And guess what? When you miss the trade tends to go in your way, and you sit there thinking, holy shit, I should have entered for the trade. Now, when this happens, you become once again a hindsight trader where you are regretting, oh my god, I should have entered for the trade. If only I entered for the trade, I would have made $500. I would have made $10,000. God damn it, I should have. And this causes you, once again, to revenge trade, right? Because when you miss a good trade setup, you tend to want to force trades, even though there's no opportunity. When this happens, you start revenge trading, you start entering into trades even though there's no opportunity whatsoever. You are purely trading based on your emotion. And we all know that is a recipe for disaster. And this causes you to lose trades, lose money. And then if you go back to trading a discretionary trading strategy, which means you're still trading based on your gut feeling and your emotion, this cycle will happen over and over again. The sooner you become aware of this entire cycle, this entire trap, the sooner you can get out of it. And then the sooner you can actually become consistently profitable. So, like I said, this is literally how the majority trade, how the 90%, the bottom 90% operate. Once again, these are the people that is giving their hard-earned money into the market. And you watching this, it's your job to take their hard-earned money. And that is why I want to present you the path to success, right? So once again, the path to failure is a discretionary trading strategy where you are trading based on emotions, guesswork, or your gut feeling, intuition, whatsoever. The path to success, we are utilizing a mechanical trading strategy. Because when you have clear defined rules in place that tell you exactly what you need to look out for on the charts, what are the trade setups that you should look out for, what is your entry criteria, how should you exit the trade. All of these decisions are answered based on rules inside your mechanical plan. And when this happens, if, like I said, if this trade setup fulfills all the criteria in our plan, we enter for the trade. If it does not, we stay off the market. As this happens, as time passes, you record your data, and now you have sufficient data in order to back up your edge. Right? When you back up your edge, guess what? This gives you confidence. Competence leads to confidence. When you build up that confidence, or rather, when you build up that solid data, like, you are winning this amount of trades, your win rate is 60%, you have cold hard data, numbers that tell you that your trading strategy is actually profitable. Guess what this does to your self-image? It makes you feel confident. It makes you feel like you can actually become profitable. And like I said, these are all raw data that allows you to back up your edge and makes you feel confident. And when this happens, the market tends to go in your way, right? Or rather, luck should be on your side. And then you master the mental game of trading. You are able to figure out how to control your emotions. Not really completely control, but rather like how to manage your emotions properly so that you don't let them take control of you, and you start trading in a robotic way. And this actually leads you to consistent results, right? Consistent results where you're actually making money consistently. And this is when you can potentially think about scaling your capital, taking your trading to the next level. And that is when you become a top 1% trader, outlier. Now, once again, this is the fundamental law. Remember, you cannot control what the market is going to do or how much money you are going to make. There is only one thing within your control, and that is yourself. You can control where to enter and exit the trade, how much money to risk on each trade, how you manage your floating positions. And by having a mechanical trading strategy, you will be able to become more consistent with your trading, with your actions, and as a result, get consistent results and make consistent profits. Now, a good trading strategy, in my opinion, is not 100% mechanical or 100% discretionary. Oh, god damn it, it's so hard to pronounce this thing. A profitable trading strategy is 90% mechanical and 10% discretionary, which means you will still need to rely on your human judgment and emotions sometimes, because the markets are always evolving. And this is why majority of the trading robots or algorithms fail, because the markets will always evolve, and you need to continuously tweak and refine your trading plan to suit the new market conditions, right? So adapt or die. In order to build a mechanical trading plan, you need to have these 4 things in place. Firstly, entry criteria. Secondly, exit rules. Thirdly, trade management. And fourthly, your risk management. When you have all 4 of this is when you are able to get a complete mechanical trading plan that tell you exactly what you should do from the start of the trading day to the end of your trading day. So now let's go through one by one. Firstly, entry criteria. As much as possible, try to stick to your entry rules. That means if the setup checks all the criteria, all the entry criteria, then enter without any hesitation. If not, stay out of the market and look for other trading opportunity. So make sure you enter the same way consistently so that you don't end up missing good trade setups and you actually avoid low quality trade setups. So you need to define these things. How do you map your market structure? Are you using the 4-hour time frame? Are you using the daily time frame to actually map out your market structure, your bullish break of structure, your bearish break of structure, your market shift, whether price is in a pullback phase or the push phase? How are you doing this? What time frames are you going to be entering the trade on? Once again, this depends on what type of trader you are. Be it a scalper who's entering on the trade on like the 1 minute time frame or the 5 minute time frame, and then a swing trader could be entering the trade on the 1 hour or the 4-hour time frame. Completely depends on your trading style. And then does the point of interest that you are entering the trade on need to sweep liquidity? Because by now you should understand that we only enter the trade when price is at a point of interest. We don't enter when price is in the middle of nowhere. We enter when price reach either a supply or demand zone. And when that happens, or order block, and when that happens, you need to ask yourself, does this point of interest that price actually reach need to sweep liquidity or not? Is it part of my entry criteria? So if it needs to sweep liquidity, then I will only enter for the trade at a sweep zone. If it doesn't sweep liquidity, then I'm perfectly fine with entering the trade on a supply demand zone or an order block that have no liquidity sweep whatsoever. And where are you actually entering the trade on, right? You need to be very specific when it comes to this. You cannot just do it based on guesswork or based on your feeling, or basically what you're feeling at that point of time, right? You need to think about, okay, are you entering on the edge of the zone, basically when price touches it, or are you entering at the equilibrium, the 50% of the zone, or the extreme end of the zone? And also, what are the confluences are you looking out for? Are you looking out for inducements, your push and pull inducements? Are you looking for liquidity, price to sweep, either the buy side liquidity or the sell side liquidity? Are you waiting for your market shift to happen, that shift of order flow, that shift of structural? What are you looking for? What is your entry trigger? So make sure you write down every single detail and leave no stone unturned. To make this strategy as mechanical as possible, so that you know exactly what you are looking out for when you go on to the charts. Next is your exit rules. For your exit rules, you want to define exactly where you will get out if your trade does not go as planned, and also where you will get out if the trade does go in your way. So once again, same thing with entries. You want to exit the same way consistently, so you don't end up cutting your winning trades early and you maintain consistent risk. So there's two types of exits, right? One, if the trade does not go as planned, and one, if the trade go as planned. So your stop loss placement, this is where you think about, okay, you want to be placing your stop loss behind your supply on demand zone, or behind your swing high or low, right? And when that happens, how many pips are you placing it behind the S&D zone, behind that swing high or low? Could it be 2 pips, 3 pips, 5 pips, or 10 pips? How many pips are you actually placing your stop loss distance? And then you need to define how many pips your stop loss should be, right? And once again, the minimum is 2 pips, because you have to take into account the spread from your brokers as well. Next, for your take profit placement, you need to decide whether you want to place your take profit based on a fixed R method, which means if price reaches 1:3R, or 1:4R, or 1:6R, you get out of the trade, no matter where price is, or no matter what price is gonna do, right? You just completely get out and respect your R multiple. Or you are placing your take profit based on technical targets, right? Okay, is quite subjective, right? You're exiting the trade at the next supply or demand zone, or the next swing high or low. Define your exit rules, because when you set your exit rules properly, you will not regret when price blows past your take profits, because you know for a fact that you are following your plan. And then if the price does hit your stop loss and end up going in your way, guess what? You will know that next time you need to make your stop loss wider and give it more breathing room. This way, you will be able to continuously tweak and optimize your trading plan while maintaining consistency in execution. Now, for trade management, once again, you want to manage your trades the same way every single time, because when you are consistent in managing your trades, your trading account tend to have like a steady growth, like an uptrend growth, rather than going through constant up, down, up, down, up, down, up, down. So you need to take into account the following thing. What trade management method are you using? The set and forget method, or the trading stop loss, or partial profits? Where are you taking partials? And if you're taking partials, how much volume are you removing from the position? And when will you start trading your stop loss? How many pips behind the swing high or low will you be trading? And what time frames are your stop loss and take profit on? You need to take into account all of these things and think about how do you actually manage your open position properly, so that you don't really leave it up all to your emotions. Oh, I feel like taking partial profits today, so I'm going to do that. Oh, I feel like moving my stop loss today, so I should do that. So no, you are just, once again, relying on your emotions. You need a clear rule-based approach. Risk management. So once again, you want to follow strict risk management rules consistently every single time you take a trade, because this actually determines how long you are able to stay in this game. Because remember, you cannot play if you run out of chips. If you run out of money to trade with, guess what? You can't trade and you can't make money. So capital preservation is really the most important thing ever, which is really, it should be one of your main focus. This part right here could be one of the most important part of this mechanical trading plan. So you need to include these things. How much money are you risking per trade? Is it 1% or 2%? And then your position sizing. So for this, you usually go to your position size calculator after you were able to determine your risk per trade and your stop loss distance. Just go to the calculator and just input everything there, and the calculator will do it for you. And how much money are you risking if you are planning to scale in? Because on the first trade, you could have scaled, or rather on the first trade, you could have entered for 1%. You could have risked 1%. And then if you want to scale in for another trade, the second trade, how much are you risking this time? Is it still 1%? Or is it 0.5%? Or is it 2% even? Right? Think about this. And what's the maximum account exposure you are willing to accept? Right? The maximum amount of drawdown you are willing to accept before you decided that this is it. And the max daily loss before you stop trading for the day. Once again, this is very important because this actually prevents you from over trading and actually lose even more money if you are encountering a losing streak. So always just remember this. When you execute a mechanical trade plan that is clearly defined consistently, you will no longer need to rely on emotion or guesswork whatsoever. All you have to do right now is to follow the rules laid out and actually execute them in real time. If there is a trade setup that fulfills your entry criteria and you actually enter into the trade, guess what? Utilize the exit rules, the risk management and the trade management part to actually think about how to manage that position. If there isn't a trading opportunity whatsoever, you stay out of the market. As simple as that. Once again, if it's difficult for you to stay out of the market, just always remember, capital preservation is key. Your focus is not to make money. Your focus is to protect your capital. And then the second focus then is to make money. But once again, remember, you cannot play if you run out of chips. So only when you have a mechanical strategy, you will be able to identify the flaws and shortcomings of your strategy so that you can continuously tweak and refine it, and as a result, your win rate will increase. So ladies and gents, just always remember, consistent action leads to consistent results. If you are consistent in terms of how you trade, day in, day out, the profits will eventually come. Right? It will eventually come. I know for a fact that it will. The opportunity will present itself, and when it does, you execute it without any hesitation, and you win, you make money, and that's how you do it. That's how you do it, by having clear mechanical rules in your plan. So now that we have established that market structure is the most important thing ever, and it lays the foundation for our mechanical trading strategy, let's go deep dive into market structure, right? But first you have to understand the basics. Now, when you really look at the markets and how it moves, and you think from the first principles, it all comes down to these three ways, right? The market can only move in these three ways. Meaning, it can either go up, or go down, or go sideways. That means it cannot go zigzag or whatever that you're thinking of, right? Let's keep things simple, right? Basically, the market can only go up, down, or sideways. And when it goes up, it's not going to go up in a straight line like this, right? That's not how the markets work, right? And when it go down, it's not going to go down in a straight line like this. It's going to go up, pull back a little bit, go up, pull back a little bit, go up, pull back a little bit before going up even further. Why does this happen? Because it's essentially like a car, right? Let's say you are a car and you are going to your destination. At some point of time, you're going to run out of fuel. And then you need to stop at a gas station to get more fuel. That's essentially the same thing as the market, right? So the buyers, when they push the price up, at some point of time, there's not going to be enough buyer to continue or rather sustain this upwards momentum. And that is when price will pull back, so that, you know, the price of the asset can get to a much more better price at a discount, and then that is when more buyers will jump in and push the price up even further. And then this cycle just repeat over and over again, right? And this is basically just how the market moves, right? If you can really understand this, this is it. Yeah, this is basically how you make sense of the market. But obviously, like I said, it's not going to be this easy, right? Right now, look at this. This looks like just simple chart diagrams straight out of the textbook. This is like the utopia perfect downtrend, uptrend diagram. And this is just not what the market looks like. Here's what the market actually looks like, right? So this is your expectation and this is your reality. Now, let's seek to understand bullish and bearish market structure even further. First of all, let's look at bullish market structure. So like I said earlier, price will never just go up in a straight line like this, right? It will not just go up like this, like in a rocket style. No, it has to go up, pull back, and go up even further. And this is what we call market structure, right? It's the structure of the market. It's the DNA of the market. It's basically how and why price move, right? So how price works is that price will push up like this, create an impulse, and then start pulling back, and then creates another impulse. Now, when it does this, right, what it does is that it creates this swing high, and then it creates this swing low. Now, this low is only validated after it led to a break of structure, when price actually goes up and break the last swing high. Okay? Let me repeat myself. This is very important. This can only be considered as a valid swing low if it goes up and break the last swing high, creating your break of structure. So what this means is that after price breaks structure and creates a new high, this high is higher than the previous high. And now we are expecting price to pull back again, because like I said, you cannot expect price to just continuously going up like this after it just break through the last high, right? At some point of time, it needs to stop, and it needs to rest, and it needs to pull back so that more buyers will jump in onto this uptrend, this bullish market structure. So that is what we are anticipating, right? So I want you to remember this. Whenever price creates a break of structure, expect a pullback. Anticipate a pullback to happen soon, right? And a lot of retail traders, what they do is that after price create this break of structure, they continue to buy, right? They continue to buy thinking that this upwards momentum is going to continue forever. And I hate to break it to you, buddy, but eventually price is going to start pulling back, right? And there is nothing wrong with buying after price break structure, but it's just that you can buy at a much better price point, right? At all of these higher lows. So after price creates this break of structure, it forms this new higher high, and then that is when we can anticipate price to pull back. And when pull back, it's going to pull back to create a new low, a new swing low that is higher than the previous swing low. And then it goes up again, creating another break of structure, breaking past the last higher high, and then create another higher high and higher low. So this is basically how an uptrend is formed. An uptrend, a bullish market structure, whatever you like to call it, is formed when price is creating higher highs and higher lows. Higher highs and higher lows. Bullish market structure. Alright, so in a downtrend, it will look like this, right? It's the opposite of an uptrend. So price will goes down, pulls back, create a new high before price goes down, break through the last swing low, creating your bearish break of structure, and then that is when we are anticipate price to start pulling back again, right? And then that is when price start pulling back again, creating another lower high, and then it goes down even further to create another lower low, right? So in a downtrend, price will be making your lower high and lower low. And remember, guys, this lower high can only be considered as a valid lower high after it has led to a break of structure. Okay, after it has led to a break of structure. So the key here is that it needs to break structure, right? In order for this to be considered as a valid high. And in order for this to be considered as a valid low, a valid swing low, it needs to break structure. Alright, so get that through your head. So by now you should know that a bullish market structure is price creating higher highs and higher lows, and bearish market structure is where price is creating lower highs and lower lows. Like I said, obviously, this is not what the market will actually look like. Sometimes it will look like that, maybe like 5% of the time, to be completely honest with you, right? Most of the time, the market looks like this, right? It looks like a gigantic mess, right? And when you look at this, right, I always want you to really think about where are the swing highs and where are the swing lows. Because if you can identify that, then you can make sense of the market structure and you can determine whether price is bullish or bearish, right? So let's go through the real graph, right? So over here, this is when price, once again, push up and then pulls back and then push up. After price push up and break through the last high, creating a break of structure, what it did is that it created a minor pullback, okay? A minor pullback, not a significant pullback yet. So after that, price just continued going up even higher before price starts creating a major pullback. Now, once this major pullback happened, this is the last swing high, okay? Not this one right here. It will be this one right here because this is the last high, the highest point before price starts pulling back. Okay, and then that is when price starts pulling back and it starts creating this bearish move a little bit, right? Because price is going to turn bearish after, price is going to turn bearish when it's pulling back, right, in order to facilitate that pullback, right? And then that is when price goes down here and then it creates a new higher low right here before price goes up even further and yeah, eventually break the last swing high, creating a break of structure. So in this case, bear in mind that the higher low will be the low that led to this break of structure. So that means it will not be this one right here, it will not be this one right here, but the lowest point, okay? The lowest point that led to the break of structure. And then that led to price creating another higher high, higher low, and then another higher high, right? And then in a downtrend, this is when price goes down, pull back, goes down, and then starts pulling back heavily. And that is when price creates another lower high before price goes down again and creates another bearish break of structure, right? Breaking past the last lower low, leaving us your lower high right here, the highest point before price goes down and break structure. And then it led to a lower low and lower high again, right? And then just continue going down, continuing this bearish market structure, right? So basically right now, for now, you just need to understand that bullish market structure, higher high, higher low. Bearish market structure, lower high, lower low. And then we are expecting a pullback whenever price breaks structure. So after price breaks structure, you are anticipating a pullback. And the pullback means what? That means the market is going to go against the swing trend for a short amount of time in order to facilitate the pullback, right? So in this case, since it's the uptrend, that means the market, when it's pulling back, is going to go into like this minor downtrend, right? To facilitate the pullback before the uptrend continue again and go up even further. Same thing with the downtrend. Since the overall trend is downtrend, right? The market is going to turn bullish for a short amount of time to facilitate the pullback before going down even further, right? So next, let's talk about swing highs and swing lows. How do you determine which one are the valid swing highs and which one are the valid swing lows? Okay, very simple. You always want to look for the highest point that the lowest point that creates the break of structure and lead to a swing high, and that will be a swing low in a bullish market structure. And then in a bearish market structure, you always want to look for the swing high, which is the highest point that creates break of structure and lead to a swing low. Let me show you some examples, right, to help you get a better understanding. And then this is when, once again, price push up, pull back, and then goes up like this. All right. So this is obviously a swing high. This is obviously the swing low. And then that is when price goes up, make a minor pullback, and then goes up even further. Right. So at this point of time, price has not made a significant pullback yet. Right. It has not made a significant pullback to create a new swing low yet. So we still wait. We wait until price starts giving us a significant pullback like this. Right. Price goes bearish to facilitate that pullback. Right. And it goes all the way down here. Now, after this, look at what happened next. Price reverse and goes up and then led to a break of structure. So you just need to identify the lowest point that creates this break of structure that led to this swing high being broken, right? And if you look at the lowest point, it will not be this one right here because there's a lower point. And it's not this one as well because there is an even lower point. And it will be this one right here. This will be the lowest point that actually led to this swing high being broken, right? And then led to a new high being created right here. So this is your swing low. Okay, so if you need help when it comes to identifying this, right, just use a box tool on TradingView, right? Just click right here, box tool. You just mark up the higher high, right? The one that just got broken. Drag it out like this and then pull all the way down to the lowest point, okay, the lowest point of price, and it will be this one right here. So there you have it. You will be able to find your higher low, your swing low right there. And then that is when price goes up even further, right, creates a new higher high and then starts pulling back, pulls back and create another lower high, right? This is to facilitate the pullback, right? It's going to turn bearish to facilitate the pullback before price goes down even lower, creating a new swing low before price goes up and breaks structure. So same thing. At this point of time, you're asking yourself, okay, since price just broke this last swing high, what is the lowest point that price went to that led to this break of structure? So you can use this box tool method, right? drag it out, and go all the way down to the lowest point, and you will see it's this one right here. This will be the swing low. That means you must go all the way down to the lowest point, not this one right here, guys. The lowest point that led to the break of structure. So that is how you're identifying your swing low and swing high in a bullish market structure. Now, in a bearish market structure, it's pretty much the same thing, right? Price goes down, led to a break of structure, and then it starts pulling back, right? We are anticipating the pullback. And then once price starts pulling back, pulls back all the way up here before price goes down even further. And then price goes down even further, break through the last low, right? Break through the last low, creating a bearish break of structure. So at this point of time, you're asking yourself, what is the highest point that created this break of structure and led to another swing low being formed right here, right? That led to price breaking past this last low, right? So you can use the box method. This time, drag up. Find the highest point that led to this break of structure, and you'll be this one right here. Right? Bear in mind, it will not be this one right here because there's a higher point. It will not be this one because there's even higher point, and it'll be this one right here. So this is the highest point that price went to before it led to a break of structure. Right? So on and so forth. Same thing right here. This is the highest point before it led to a break of structure. Now, why is it so important for you to actually understand this valid swing highs and swing lows? Because more often than not, I found that most traders, when they're just starting out, they end up marking the wrong swing lows and the wrong swing highs. Instead of marking this low right here, they think that this is the swing low, right? And if you mark this as a swing low, it's invalid. Because what happens next is that later on you will learn about market shift, which means after price break through the swing low, right, that means price is going to reverse to becoming a downtrend in an uptrend like this. So if you mark this as a valid swing low right here, now if price goes down and break past this supposedly swing low that you have marked up, you're gonna think that price is gonna reverse, when in reality it is just pulling back, right, so that it can go up even higher. And it's all because you did not identify your swing low properly, right? So please make sure you really try and get this straight ahead, right? Mark the lowest point, that is the swing low, and the highest point is the swing high. Okay, and also bear in mind that these lows and these highs, they'll be somewhat protected, right? Which means in order for price to actually continue this uptrend, right, price cannot breach this higher low, right? So if price goes all the way down here and it breaches this higher low, most likely this uptrend, this bullish market structure is compromised and it's going to turn bearish soon, right? Like I said, don't worry about this because we are going to learn about this later. For now, just know that it's important for you to identify the correct swing high and the correct swing lows. Now, let's talk about swing range. Now, swing range is basically the range between your swing high and your swing low. Now that you have learned how to identify your swing high and how to identify your swing low, it's time to understand how to identify your swing range. And your swing range is basically the area that is in between your swing high and swing low. As simple as that. No need to complicate things whatsoever here, right? So in this case, we have your swing low right here, right? Which we have validated, right? This swing low is the lowest point that led to this break of structure and created this new high right there. So this is the swing low. And then you must ask yourself, where is the swing high? The swing high is the highest point before price starts pulling back, and it will be this point right here, right? So this is a swing high, and then this is a swing low. Now, this is basically your swing range, right? After you marked up your swing high and swing low, this entire range right here will be your swing range. And bear in mind, this is the range that we want to be focusing on. That means we will not be giving a shit about what price is doing all the way back like years ago, weeks ago. No, you want to focus on what price is doing within the swing range itself, right? What price is doing right now, right? And then based on this, you must understand that as long as price respect this swing range, no matter how low it goes, as long as it does not break past this swing low, it is still considered as an uptrend. It is still considered as a bullish market structure. Like, so what this means is that price can, after creating this break of structure, we are expecting, or rather anticipating, price to start pulling back, right? So that is when price starts pulling back. Okay, it starts pulling back, goes down, pulls back. That means it can go all the way down here, and it's still counted as an uptrend, right? And because this is still essentially a pullback, as long as it's still within the swing range, right? Eventually, if price breaks out of the swing range, that is when we have a problem. That is when price could potentially reverse to becoming a downtrend, right? So for now, you can see price just keep on pulling back and respect this swing range, right? Come back all the way down to this lower low before going up even further like this. This means this is a continuation and price is just going to continue going up, right? This bullish market structure is just going to continue, right? So in the downtrend, same thing, right? Your swing range will be the swing high and your swing low, and that would be the range between the swing high and the swing low. Is pretty much the same thing, right? So in this case, you can see this is the lower high and then this is the lower low. This means that price can pull back after this break of structure. It can pull all the way up here, right? And it's still considered as a bearish market structure unless price break through this last swing high, right? Then there could potentially be a reversal. So yeah, price can most likely come all the way up here and then it can still go down and create another bearish break of structure and continue this lower high, lower low dynamic, continuing this bearish market structure. All right. So yeah, please get this through your head, guys. This is very important. Like I said, this is the basics. This is the foundation. And bear in mind that within this swing range itself, right, you will notice that there is also your internal structure, because this is your swing structure, right? Your swing high, swing low, this is your swing structure. And within this swing structure, there is minor market structure being formed, internal market structure being formed. Like example, in this case right here, price goes down, create a lower high, lower low, lower high, and then another low right here. So in this case, this is not part of the swing range because this is just what price is doing within the swing range, right? I mean, this is not a swing high or this is not a swing low, right? Because we have identified that this is a swing high, right? And this is the swing low. So this is not counted as a swing high and this is not counted as a swing low. In that case, this will be your internal low and this is your internal swing high. So internal swing high, internal swing low, right? And this is basically your internal structure, right? Everything that is contained between this swing highs and this swing lows, this is your internal structure, right? Same thing right here. This is your internal structure. For now, don't worry about this yet. Like I said, focus on mastering the boring fundamentals, right? Focus on building that foundation, getting the basics right before we can even talk about internal structure, right? Last but not least, before we wrap up these basics of market structure course, I want to actually go through your strong and weak highs and lows. So earlier on, we talked about how to identify valid lows and valid highs, and it's actually leading to this part right here. This is where we can learn where exactly to enter, right? I want you to keep things very simple once again, right? When it comes to bullish market structure, there will be strong lows and there will be weak highs. When it comes to bearish market structure, there will be weak lows and strong highs. Let me explain what I mean when I say weak or strong, right? Because how do you really define what is weak, what is strong? So in a bullish market structure, price goes up and then it pulls back. And then it goes up and it creates this break of structure, right? When it creates this break of structure, this is basically price breaking past the last swing high, right? Which tells us that this high is weak. Okay, it is a weak high and it can be broken. And when it creates this break of structure, this tells us that this low is strong, right? This strong low is formed after this break of structure happened. This means that the buyers pretty much overpowered the sellers and pushed price up and reached the last high. So this is how your weak high, the term weak high is formed, and strong low is formed, right? So in the uptrend, the lows are strong because price is just creating that higher lows, right? And it's just respecting and it's just going up like this and just continuously breaking past the last high, right? Just breaking past the last high. So weak highs, strong lows. Okay. And same thing right here, right? In this case right here, price goes up, create a high, pulls back, and it led to a strong low breaking past the last weak high, and then it starts pulling back, creates another high, right? And then starts pulling back once again, and then it creates another strong low before price create the break of structure, right? Breaking past the weak high. So in this case, right, I want you to take into account this tip that I have for you guys to really keep things simple. We want to trade from strong structure, trade away from strong structure, and we want to target weak structure. This means in a bullish market structure like this, we want to trade from these strong lows. That means we want to enter for a buy on these strong lows right there. And then when we enter for a buy right there, where should we target? We want to target the wick highs, right? We want to target right here. So if I enter for a buy right here, I'm going to be targeting this area. If I enter for a buy right here, I'm going to be targeting this area. Okay, same thing right here, right? I'm trading from strong structural. I'm entering for a buy here. I'm entering for a buy here. I'm entering for a buy here at all these strong lows. And then I'm going to be targeting these wick highs right there. So in a bearish market structure, right, you pretty much once again be the opposite. So this is when price goes down, right, pulls back and goes down and led to a break of structure. Now in this case, it's the opposite. This case, the highs are strong, right? Because it's the highs that actually led to a break of structure and led to price breaking the last low. So these are weak lows and these are strong highs. Okay, so continue creating your strong highs, weak lows, strong high, weak lows, right? Creating that bearish break of structure, right? Same thing right here. So in this case, in this bearish scenario, using this principle where we want to trade from strong structure and target weak structure, that means we want to enter for a sell at these strong highs, right? We enter for a sell here at this strong high, enter for a sell here at this strong high, enter for a sell here at this strong high, and target where? Our weak lows that we have right here. Okay, so in this case, right here, there's a low being formed, there's a high right here, right? This is a strong high, right? So if I enter for a sell right there, I'm going to be getting out right here at these weak lows, right? And same thing right here, right? If I'm entering for a sell right here, I can easily get out at these weak lows. But this is basically the principle. Now, for now, I don't want you guys to worry about this too much, right? I don't want you guys to worry about where to enter and where to exit for the trade yet. Like I said, focus on the foundation. Focus on really making sure that you master all of these basics of market structure before we move on to bigger things, right? So just to give you a quick recap, in an uptrend, price will be creating your higher highs and higher lows, right? And when it creates higher highs and higher lows like this, it's going to let this higher low is going to lead to a break of structure, right? Where price break through the last swing high. That is why price is able to create these higher highs and higher lows, because it's continuously going up, right? And just breaking structure. And then there is your strong low being formed in a bullish market structure, and then there is your weak highs, right? Strong low, weak highs, and we want to trade from these strong lows and we want to target these weak highs. And then we also talk about your swing structure, right? And your swing range. So swing high, swing low, this will be your swing range, right? Swing high, swing low, this will be your swing range. And then last but not least, we also talk about how there is 3 types of trend, right? Your uptrend, downtrend, and consolidation. And you always want to just be asking yourself, is the market going up, down, or sideways? And then based on that, you can trade accordingly, right? Example, we have determined price is uptrend, then we can look for buys right here, right? And then if we have determined price is downtrend, we can look for sells right here at all of these strong highs, right? So yeah, basically, like I said, the thing about this basics of market structure is that you guys must really understand this, because this is pretty much what forms the market. This is the DNA before of price, right? So if you can really understand this, then you can really make sense of what the market is doing, what is the trend right now, who is in control of price, and then you can trade accordingly and make sure that you are on the right side of the market, right? So yeah, go and try to really make sense of this, right? Rewatch this lesson if you need to. Now, when it comes to market structure, it can get confusing because you watch a YouTube video and it shows you something like this, and it looks very simple on textbook, on a video. But when you go to the actual charts, you are confused by the different trend direction. Price going up, then down, then up, then down, up, down, up, down, up, down, and just going in circles. And you are sitting there confused on whether price is actually in an uptrend or downtrend. And that is when I'm going to give you a secret. The secret is a run on a higher time frame is a trend on a lower time frame. So what does that mean? If you look at this right here, it's an uptrend. Price is creating your higher highs and higher lows, higher highs and higher lows. And every time price push up, that's a run. And retrace, that's also a run. And then push up again, run, 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 run. So this whole thing constitutes a trend. So that is what I mean when I say that a run on a higher time frame constitute of a trend on a lower time frame. So within all these runs, you will see your mini trends, right? You'll see price creating higher highs, higher lows in the smaller time frame, the lower time frames, and then it starts pulling back and actually reverse to becoming a downtrend on the, once again, the lower time frame, and then reverse and head back up, creating your uptrend again, and then creating your downtrend again. So in this case, you can see on the higher time frame, price is actually making a very nice uptrend, right? Higher highs, higher lows, higher highs, and higher lows. But if you go down to the smaller time frame, like the lower time frame, you will actually see price creating these mini trends, right? Price is creating this mini uptrend, mini downtrend, mini uptrend, mini downtrend. So that is what I mean when I say that this overall run consists of a trend on a lower time frame. Same thing right here. This run consists of a trend on the lower time frame. So a run on a higher time frame is a trend on a lower time frame. That is the key. Remember that. Because to be honest, once I really understood this, that is where I just like opened my eyes to really the way the market move. Like I'm able to be in sync with the market right now. So if you still don't understand, let me explain it and simplify it even further. Now let's look at the higher time frame structure first. So price is going up and then it starts pulling back. And then price is going up again, creating your break of structure, right? Price break the last high, creating your break of structure somewhere right around here. So now price has created a new high and a new higher low. So higher highs, and then price starts pulling back again, creating another higher low, and then eventually it goes on until price eventually loses steam, right? Remember, nothing goes up forever. Whatever goes up must come down. So eventually price will lose steam, and then what happens is price will go down, break past the last higher low, creating what I call the market shift. So the market shift is the first sign that this overall trend is about to end, and right now the trend is going to reverse to becoming a downtrend. So once a market shift is present, price broke through the last higher low, we are expecting price to pull back to create a lower high, to confirm to us that price is in bearish order flow right now and price is about to collapse to becoming a downtrend. And that is exactly what price did, right? Price created a lower high right here, and you can see this high is lower than this high right here. So this pretty much just confirmed to us that this overall uptrend right here is over, right? It's game over. Now it's downtrend, so we should be looking to shorts, and then you can start seeing price go down even further and then pulling back again, and then go down even further, creating your lower highs and lower lows, right? Simple, basic market structure. And this is what price looks like maybe on the higher time frame, on the 4-hour or the daily time frame, right? Very smooth, very easy to read. But once you do a top-down analysis, things start to get a little bit more confusing. Once you start going down to the 4-hour time frame, and then there's the 1-hour time frame, and then there's the 15-minute time frame, things start to get a little bit confusing. So now let's go down to the lower time frame. So the lower time frame structure is this gray color line that you see behind the big black bow lines. Okay, first of all, when you look at the lower time frame structure, always remember what I said when I say that a run on a higher time frame is a trend on a lower time frame. So this is a run, which means within this run itself, there's gonna be a mini uptrend, right? Price creating your higher highs and higher lows. And then eventually when it starts pulling back, right? When price starts pulling back, it's gonna pull it back first on the lower time frame. So you'll start to see price breaking structure on the lower time frame first. So you'll probably see some sort of market shift happen right here, right? You can see a market shift happen right here where price broke through the last higher low. So this pretty much tells us that this run right here is about to retrace, because this bullish uptrend on the lower time frame has just been broken, and right now price is about to retrace because price has given us a market shift. So we are expecting a pullback right here, and then when do we know the pullback is going to end? When do we know this overall pullback is going to end? When there is another market shift. That means price has to break the last lower high. So right here, price starts creating your lower highs and lower lows, and then this is the last lower high right here, right? And then price starts shooting up, breaking past the lower high. Once again, indicate to us this retracement is done, right? So we should be looking for this continuation right here. Price is going to continue to become an uptrend, and that is exactly what price did. And then the same thing happens again. Once price start pulling back, guess what? We are waiting for market shift once again to take price all the way up, and so on and so forth, right? You can see these things don't change. This is essentially how price moves, right? It creates the same patterns on a higher time frame, on a lower time frame, and that is why I say the market is fractal. Because whatever market structure that happens on the higher time frame happens on the lower time frames as well. And what happens on the higher time frame must first happen on the lower time frame. And now if you really understand this, it becomes much more easier to trade. So the next time price breaks structure and starts creating another higher high, you can wait for price to pull back, and then that is when you can look for your buy position at these pullbacks right here. But how do you know when to buy? When the lower time frame trend, this bearish retracement, ends. When it ends, when you get the market shift, that is when you know the trend is about to continue, and that is where you can get in for a buy position, right? And then same thing right here, eventually the trend reverse, and first things first, it reversed on the lower time frame, right? So I want to point your attention to right here where the trend is reversing. You can see the higher time frame structure, it only starts creating the market shift right here. But if you actually go to the lower time frame structure, right, you actually go down to like the 1 hour time frame, you will see that it already gives you this market shift somewhere right around here. Right, somewhere right around here, you already know for a fact that this overall entire uptrend is about to end. Right, it's about to end. So this is where you could have easily got in for a sell position right here at this market shift. Ideally, when price retrace, create this low high right here, enter for a sell there, and take it all the way down. And this is how you catch these insane reversal trade setups. Now, so this higher time frame structure that you see right here, this could be on the daily time frame. So what does it actually looks like on the weekly time frame? On the weekly time frame, it could look something just like this. This huge up move, and then this huge pullback right here. And before price actually creates another up move. So on like the weekly time frame or something, this could just be a complete retracement. So this wasn't really a downtrend, but in reality it's just a retracement of the overall higher, super duper higher time frame trend. So now that we are actually on the charts, let's apply whatever we have learned so far. So right now you can see that price was in an uptrend, right? Because this is on a higher time frame, and you can see the 4-hour trend is very bullish. Price is creating your higher highs and higher lows, right? Higher highs and higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, and higher lows, right? Very, very clear. Everything is good so far. It's a good day to look at the charts. But then, like I said, if you go down to the smaller time frame, you will start seeing this as something will look something like this. Like you will just like start declining very, very much, and then you look at this again and then start seeing price creating this downtrend, and you start thinking that this is actually a downtrend. Like I said, when in doubt, just zoom out, right? Just zoom out to the higher time frame, and everything will just make so much more sense for you. So eventually price starts going over here and then starts consolidating, losing steam, and then eventually it creates our market shift somewhere right around here. This was the last higher low, right? This is the last higher low, and then price breaks through the last higher low, creating your market shift. Now the moment price breaks through the last higher low, creating your market shift, we are waiting for price to create the lower high, which it did right here, right? It created a lower high right here. This high is lower than this high right here, which pretty much confirmed to us that price is about to go down. Now if you look at this, maybe you can go down to the smaller time frame, and you can start to see that, okay, that is actually bearish order flow, right? There's a lot of selling momentum, selling pressure right here. But before this actually came in, there was actually this big bull candlestick right here, this big bullish candlestick right here, right? So this was the last sign that showed us that there was still some sort of bias at this zone right here. But after that, price just started collapsing. You can see price starts collapsing, breakthrough this last higher low with such a huge amount of selling pressure and selling momentum. You pretty much know that price is about to go down right here. So from this onwards, we are looking for sell position, right? We are looking for sell position. So we wait for price to pull back, and then we can potentially look for our sell position somewhere right around here. And that is when you can see price just starts going down, right? Easy as that, right? This is somewhat like an order block. So if you don't really understand order block, there's another video on that. I'm not gonna dive deep into it, and that was how I managed to like predict this move right here, right? Basically all these order blocks where price actually retest it and then go down even further. Yeah, so I'm not gonna dive too deep into entry, but you can see this is what the lower time frame structure looks like, right? Price starts pulling back once again, and then before going back down even further, and then pull back again and go down even further, creating your lower highs and lower lows in downtrend, right? basically a downtrend. When you identify your multi-time frame market structure, you need to know exactly where to enter for the trade so that you can get this high risk to reward ratio trades. And the truth is, you want to enter when price is cheap if you're entering for a buy. And then if you're entering for a sell, you want to sell at the highest point, right? Buy low, sell high, clear as day. So ideally, in this uptrend right here that we want to enter in the lowest point, right? It could be here, right here, or it could even be right here, right? Ideally, my entry will be right here. Let me explain why step by step to get you to my sniper entry strategy, whatever you like to call this. All right, so first of all, let's start off with the higher time frames, right? The higher time frames, the 4-hour time frame, right? So we see that price has been creating your push phase, right? Price push up and then it starts retracing, and then it push up again, breaking past the last higher low that we have right here. Now once price broke past the last higher low right here, it created this low right here, right? This pretty much validate to us that this is the last higher low. So this is the last higher high, and then this is the last higher low, and now price is creating your new higher high, right? And right here price starts going up and then pull back a little bit before go up even further. So I wouldn't really consider this one as a valid pullback, right? Because price did not really create like this valid strong low, right? So this could just be a very weak pullback, like a mini pullback before price goes up. Right, once price goes up, right, it created this higher high when price starts retracing massively. All right, so here we have our 4-hour high and then we have our 4-hour low. So these are the 2 points that we need to take note of, right? These are the strong points that price will have a very strong supply or demand. So the minute price actually broke through the last higher low, right here, your next step is to wait for price to pull back, right? Because you cannot be entering right here, right here, right here, or right here. If you do, your stop loss must be all the way down here, right? You want to get the best entry, right? And chances are you have already missed this up move. Then in that scenario, you can potentially wait for price to pull back. So the minute price starts pulling back, how do we know that price is going to enter a pullback phase? When price actually break through the last higher low. Now if you look towards the left, where's the last higher low? The last higher low is right here, right? This is not a very strong low, right? This is the last higher low of this like push phase. So the minute price actually goes down, break past the last fractal higher low, we know for a fact, creating our market shift, that is when we know that price is about to retrace. Price is about to enter the pullback phase, which means we shouldn't be buying anymore, right? Like I said over here, yes, you can enter for a buy right here still, but your stop loss must be all the way down here, and that is not what I will personally do, right? That is when right now price is in a pullback phase. The minute price starts entering the pullback phase, we are in this downtrend and we don't know exactly when this downtrend will end. That is when we should not enter for a buy anywhere here. So right here, that is where bearish order flow takes place and it starts creating your lower highs and lower lows and lower highs and lower lows, right? Like pulling back, like I said, right? Where is it gonna pull back? It's gonna pull back to a place where price is cheap. Remember, if you think about how smart money trade, right? They are not gonna be buying up here. They want to buy at a discounted price. Like I said, buy low, sell high. So they're gonna buy somewhere down here within this bullish order flow area, near this previous last higher low, where there's going to be a lot of demand at around this area right here. Because remember, if you look at the higher time frame, price is going to create a higher low right here before pushing up even further. So we're expecting price to retrace all the way down to somewhere right around here, right? Somewhere right around here, you'll probably find like some sort of demand zone right here, or some sort of order block area right here for you to actually enter for the trade. Let me just quickly recap again. So over here, this is the 15-minute time frame trend, right? This is the 15-minute time frame trend, and right now price has turned bearish to facilitate this pullback. So right here, price is going to retrace to a discounted price. What I like to do is to actually have my premium and discount tool right here. You can see this is where price is the premium. That means that price is expensive, and this is when price is in a discount below this 50% level right here. And most likely price is going to retrace to the discounted price, and I draw it by marking the swing high to the swing low right here. So price is gonna retrace to an area, a strong point of interest within this discounted zone. Like I said, it could be at a demand zone within this discount area, or some sort of order block area right here, right? We don't know, that is why we play by ear. So let's just assume that there was a demand zone somewhere right around here, and price has managed to get down to this point of interest, right? Get down to this strong demand zone right here. So the minute price gets down to this demand zone, we can look to enter for a buy, but we never ever want to assume that price is gonna mitigate this demand zone, because chances are price could go down even further to touch this 4-hour swing low to grab liquidity before fueling this up move, this continuation move. So we never ever want to assume that price is done retracing. That is why we want to play by ear to wait for our market shift. We want to wait for this pullback phase to end, to switch to bullish, from this bearish order flow to bullish order flow. And that is when price starts to react at this demand zone, we are still patiently waiting to see what price does. Whether price actually break through the last lower high right here, creating your market shift, which signify to us that this downtrend, or rather this retracement, is going to end and price is going to continue to go up right now. Or the second option is that price is potentially going to create more lower highs and lower lows until price eventually get down to this 4-hour swing low. So those are the two options, and in this case we got the first option where price actually mitigate this demand zone and then come up here, break through the last lower high right here. Right, there was a lot of demand right here, a lot of buyers, a lot of buying momentum and pressure breaking through the last high right here, now giving us our market shift. So the moment this happens, we know for a fact that, you know what, this entire retracement is about to end, and that is when we are looking for our opportunity. We are looking for our opportunity to enter for the trade. And ideally, you can easily enter for a buy somewhere right around here already. By all means, go ahead. But what I want to do is to get the best of best entry, the best, the tightest stop loss, right? So that I can minimize my risk and maximize my reward, my profit potential. So in that case, I will go down to the lower time frame, right? Like this could come in the form of either the 5-minute time frame or the 1-minute time frame. And if you look at this, after price break through the last high, right, creating this bullish move, it pretty much confirmed to us that right now the lower time frame trend, the 15-minute order flow, which used to be bearish, now it has turned bullish. And now 15-minute is bullish, higher time frame trend is also bullish, and now we get this like alignment of the lower time frame structure and the higher time frame structure, giving us additional confluence that price is about to take off and it's gonna go up right now. So in that case, I'm gonna be waiting for this swing move right here to actually start pulling back, because like I said, after price created this market shift, it will pull back. It has to pull back to create that higher low before price goes up even further. So where is it going to pull back? Once again, premium and discount, right? Pull back that premium discount right here, and price going to come and pull back to somewhere within this discounted zone. And ideally, there is probably an order block that created this market shift right here, right? And that is when I will wait for price to pull back to that order block right there, and that is where I will look for my entry. So once again, I go down to the 5-minute time frame. You can see this is the, once again, another small little pullback right here before price mitigate this order block right here, break through the last lower high. Once again, the smallest bearish order flow to facilitate that market shift, and then right now switch bullish right here, right? Pretty much switch bullish right here, and that is where I'll potentially enter somewhere right around here and take profit all the way up at this swing high on the 4-hour time frame and place my stop loss below this last higher low. And this is how you catch those like insane risk to reward ratio trade setups, right? Because now the 5-minute time frame, the lower time frame is bullish, the 15-minute time frame is bullish, the 4-hour time frame is bullish. All the time frames are aligned towards the same order flow, which is all bullish, which pretty much give us the confirmation that we need to enter for a buy position. So that is essentially how you can trade this type of continuation, right? Once you get all the time frames all aligned to bullish, right, that is when you can enter for a buy, and you can start seeing price will go up here, tap into this supply, starts retracing, goes up again, creating a higher highs, higher lows, tap into this supply again, and then starts creating a higher highs and higher lows, and eventually it's gonna come up here and break past this next 4-hour high to create what? Your higher high on the 4-hour time frame. And then eventually it will start pulling back again after price break the last high, and this whole cycle will repeat over and over again. This is how the market moves. Remember, the markets are fractal. Now let's apply this market structure strategy onto the charts itself. So right now we are on the higher time frame, we are on the 4-hour time frame, and we see that price is in an uptrend, right? Clear as day, uptrend. Price is creating your higher highs, higher lows, higher highs, and higher lows. And just to make things even more clear, what you can do is to mark up the highs, and this is your bullish break of structure where price broke through the last higher low, the last higher high, and then create a new higher high. And then same thing right here, your break of structure right here. And right now this is the last high before price starts pulling back massively to create your new higher low. So right now price has just broken past the last high, creating your break of structure. And right now we are able to identify our 4-hour swing low, right? If you look at this, clear as day, this will be your 4-hour swing low. So we can put this as our 4-hour low, right? Our 4-hour swing low. Now, where is our 4-hour swing high? We don't know yet because price haven't started pulling back. Once price starts pulling back, and that could confirm to us that this would be the 4-hour swing high. So we still wait and see, and you can see price starts going up even further, go up even further, and then eventually starts pulling back. You can see the minute price starts pulling back, we could confirm to us that this is our 4-hour swing high right here, right? Remember, this is when the opportunity starts to arise, right? Chances are, like I said, if price is all the way up here, we don't want to be entering for a buy. We want to wait for the pullback to happen, right? And that is what price is giving us right now. So the 4-hour overall order flow is an uptrend, it's bullish, and we want to enter for a buy. And right now, price has started retracing. How do we know that? We go down to the smaller time frame, right? We go down to the 1-hour time frame, and you can see if you go down to the 1-hour time frame, where is the last higher low, right? This could be the last higher low. You can see price starts creating higher highs, higher lows, and then starts creating another higher high before price actually starts creating this higher low. And somewhere right around here, there was the market shift, right? Because price failed to create another higher high. So over here, clear as day, this is what I will constitute as our market shift right here. So the minute price actually created this market shift right here, pretty much confirmed to us that price has turned bearish in order to facilitate this pullback on the 4-hour time frame, right? So right here, yes, you can enter for some sell position here and there and take advantage of this pullback until price eventually reach to somewhere like a discounted area, right? So yes, you can look for your sell position right here, but I wouldn't necessarily do that. I mean, it's up to you honestly, but you can start seeing price starts pulling back. Let's go down to the higher time frame actually. Yeah, we can see price starts pulling back, massive pullback, and in this area, like I said, we want to wait for price to actually pull back to a discounted area. So what you can do is to draw your premium and discount right here, and you can see once you draw a premium discount, price is gonna retrace to the discounted price, which is below this 50% level right here. And then I will expect price to actually retrace to either this order block right here or this extreme order block right here. Right, these are the two strong demand zones that I could potentially look out for, right? My strong demand zones that I could potentially look out for to see when price is gonna react to it. And you can see price right now just created this strong reaction at this order block right here, and it's also within this discounted zone. So we could potentially look for our entry somewhere right around here, where price is actually switched to bullish order flow, right? The lower time frame. Remember, the lower time frame structure has to switch to bullish as well before we actually enter for the trade. Going to the 15-minute time frame, you see that price has mitigated this demand zone that we have right here, and right now price is at a discounted price. So chances are there could be a lot of buyers within this area right here pushing the price up. Now, where is the last lower high within this overall retracement right here? This overall retracement, you can start to see price starts pulling back, waiting lower high, lower low, lower high, and this will be the last lower high right here. So when price breaks through the last lower high, what does this give us? This gives us your market shift, right? So price has the market shift, and right now we could potentially be waiting for price to pull back somewhere right around here, create this new higher low somewhere right around here before taking off, and that is where you can potentially look for your trade setup, right? So we're still waiting very patiently, right? And you can start to see price starts pulling back, right? So once price starts pulling back to create this higher low, this could potentially be a point of interest for us to actually enter the trade, right? Let's see how price react to this, right? You can see price starts going down even further. Okay, it tapped into this demand zone once again, so let's see whether this demand zone will hold. Okay, okay, you can see, as you can see, like I said just now, right, there's a no 100% chance that price will retest to this demand zone right here. Like I said, it could even go down even further to all the way down here before price actually reacted and actually starts reversing and hit back up, right? We never ever know which zone it is, so we are still playing by ear. And you can start to see, okay, price seems to be respecting this one right here, and you can see bullish order flow start to take place. Price created your market shift somewhere right around here where price actually break through the last lower high right here, and that is when price actually starts pulling back, right? Price pull back, create this higher low, and that is when we could potentially look for our entry somewhere right around here, right? Somewhere right around here, this could be our entry, and maybe we could enter like somewhere right around here when price actually mitigated this, creating this higher low right here. And right now the 15-minute time frame is bullish, right? I personally like to enter the trade on the 15-minute time frame, right? For some of you who want to enter on the 5-minute time frame, by all means go ahead, but I like to enter on the 15-minute time frame because I'm more of a intraday and swing trader. And then this is when you can place your take profit all the way up at this 4-hour swing high right here, right? And you can see right here, and I'll say the best entry would have been somewhere right around here. Let's see whether price actually reacts to this, right? Reacts to this zone and starts going up. Okay, price is looking good so far, and you can see once price starts doing this, right, you can see market shift happen, and this bearish order flow, this pullback right here has pretty much ended, right? And this is when we know that price is back to bullish. The 15-minute time frame is bullish, the 1-hour time frame is bullish, and right now it's aligned with the overall trend, this overall uptrend, and that is where we got this like very nice entry right there. And you can see price starts spiking up, goes up even further and further, and yeah, eventually it's gonna go up there and smash our take profit. As simple as that, right? This is a very simple strategy. Like I said, if you understand how market structure, how it really all works, then that's all you need in order to trade profitably. And if you actually look closer at this 4-hour order block that we have right here, or rather this demand zone, price actually created a liquidity sweep somewhere right around here, right? Where price actually broke past the low right here, sweep the liquidity before creating your equal lows right here and just hit all the way up. Now that is liquidity concepts, which is a little bit more advanced stuff, which I'm talking about in another video. So just to sum up this entire strategy, we are looking at this multi-time frame structure, right? We are not just focusing on just one time frame. We are looking at this overall different time frames using our top-down analysis approach, and we are waiting for all types of time frame, the structure to align to either bullish or bearish. And remember, whatever happens on the higher time frame must happen on the lower time frame first. You need to understand what is a range or consolidation. Ranging markets occurs when price is not trending and actively creating higher highs and higher lows, or lower highs and lower lows. It's just going sideways just like this. In a ranging market, price is essentially just moving sideways, oscillating from premium to discount and actively trying to seek fair value at the equilibrium. When price is within the premium zone, the asset is too expensive. So as a result, there will be supply driving price down. When price is within the discount zone, the asset is too cheap, which means there will be demand driving price up. Eventually, the market will break out of this consolidation either to the upside or the downside. What you need to understand is that it requires a lot of money in order for price to break out of this range. Brokey retail traders like us are not able to move the markets no matter how hard we try, even if you are trading with like a few $1 million. Now the question becomes, who is actually capable of moving the markets and cause price to break out of this range? Obviously, the big boys, the banks, the financial institutions, the hedge funds. Therefore, when price breaks out of a range just like this indicates that smart money have entered into the market and is causing a significant imbalance between supply and demand. So when price breaks out of the consolidation, it usually comes back and retests it to fill up the remaining orders before continuing. This is based on the concept of order flow, which is split into 4 stages: range, initiation, mitigation, and continuation. Therefore, a supply zone is being created after price aggressively moved out of the consolidation to the downside. So your job is to wait for price to come back and mitigate this supply zone to fill up the remaining sell orders And this is when you enter for a sell in order to trade the continuation in price. On the other hand, demand zone is being created after price aggressively move out of the consolidation to the upside. So your job once again is to wait for price to come back down here to mitigate the remaining buy orders and trade the continuation. That is when you enter for a buy. Now that you have understood the basics, what are supply and demand zones and how are they created, let's talk about how to draw them on the charts itself. Now, before we go on to the charts, I just want to give you a very quick tip on how to actually spot these supply and demand zones. And that is to look for imbalance in price. Remember, what we are doing is that we want to see price breaking out of the consolidation. We want to see price move from balance to imbalance, which indicates that smart money has entered into the market. This means that when you are trying to spot supply and demand zones, you just need to identify one of these 4 scenarios you can see on the screen right here. When you are trying to spot your supply zone, you just need to see price aggressively moving down, and then it stops a little bit, consolidate here a little bit before going down even further. And you can see price broke out of the consolidation to the downside. So this is pretty much your supply zone. Now you must understand the rationale behind this. Why does price actually stop? It's like a car, right? A car cannot run forever when it's on its way to its destination. Price will never just aggressively move down or up forever. At some point of time, it will stop and consolidate just like this, so that more sellers or buyers can jump into the market and push price down even further. Now, another type of supply zone is being created when there is a reversal in price. You can see price move up, consolidate, and then breaks out of the consolidation once again to the downside, right? Causing a reversal in price, which tells us that this is our supply zone, right? The opposite is true for your demand zones. Price push up, pause a little bit, consolidate before going up even further, demand zone, and then price move down, consolidate before going up, demand zone, right? So I just want to keep things very simple, as I've always done on this YouTube channel, right? Don't try to overcomplicate things. Just look for one of these 4 scenarios when you are trying to identify your supply and demand zone. Because at the end of the day, the market can actually move in 3 ways: up, down, sideways. It cannot do like triangle or backflips, alright? Now, when it comes to drawing your supply and demand zones, there are 2 main ways to actually do it. The first way is the range method, which basically states that you need to mark up the entire consolidation that price has just broken out of. So in this case, right here, you can see price is consolidating and then price break to the downside. So we know that somewhere around here, that is your supply zone. Now, we basically find a consolidation, which is this entire mess right here, and you draw a box from the highest point to the lowest point of the consolidation, and you simply drag it out just like this, right? Just mark up this entire consolidation just like that. In this case, this is our supply zone. So right now we know that price has just broken out of this supply zone. This means that there is some remaining sell orders yet to be filled within this entire supply zone. So we can expect price to actually come back up to mitigate this supply zone over the next week or so before going down even further. And this is when we can look for a sell position. Just to show you more examples on the range method, you can see right here price is consolidating and then it breaks to the upside, which means that is your demand zone right here. So we will drag it from the bottom of this entire consolidation to the highest point of this entire consolidation, and we'll mark up our demand zone right there, right? Once again, you want to ensure that you really include the low and the high of the entire consolidation. So in this case, this is the high of the entire consolidation, so I'll just mark it up just like this. So you can see this is the demand zone, and look at what price did, right? Price broke out of the demand zone to the upside, and then later on, it came down here and mitigate this demand zone before going up even further. Once again, to activate or rather to fill up the remaining buy orders before going up. And then you can basically see more supply zones right here. You can see mark up this entire consolidation right here. This is your supply zone right there, right? Price broke out to the downside, and then look at what price did. Price came back up, mitigate the remaining sell orders before going down even further. So this is your supply zone, and then there is also another supply zone right here, right, which caused price to actually go down to the downside. Okay, so you have learned the first method to draw your supply and demand zones, and that is your range method. The second method is what I call the pivot method. Now, the pivot method requires you to actually refine your supply and demand zones to a single candle before the breakout itself. Now, hear me out. If we want to actually utilize a range method, let's say we are waiting for price to come back up here to mitigate this supply zone, and we enter for a sell right here. You can see it's a very large range, right? You have to place your stop loss above this supply zone, very large range to play with. So in this case, we want to actually refine this supply zone so that we can have much better entries by using the pivot method. And the pivot method basically requires you to refine this entire zone to just a single candle. So in this case, it'll be this candle right here. Now, hear me out. If we were to actually utilize the range method, what this means is that we are waiting for price to come back up to this range, and then we will enter for a sell, maybe somewhere right around here. But here's the thing, if you actually enter for a sell right here, your stop loss will be above the supply zone. And as a result, you will have such a wide stop loss because you have a very bad entry. So in order for us to get better entries, right, to minimize our risk, we need to refine our supply and demand zones. And that is when the second method, the pivot method, comes in. The pivot method allows us to actually refine our supply zone further, right? Instead of taking this entire consolidation, we look for the pivot candle that causes price to actually reverse or break out of this entire range, which will be this candle right here. You can see after this candle is formed, supply stepped into the market and caused price to move down aggressively to the downside. Now that we have refined our supply zone, you can see our entries is much better, right? As a result, this gives us a high risk reward when we are trading. So let's just quickly refine these supply and demand zones that we have drawn on the charts. You can see I'll just utilize this entire box and minimize it to just this pivot candle itself, or even this one right here. And this is pretty much your entire supply zone. You can see price step into the supply zone and then move down even further. Same thing to this supply zone, it can be just refined to this candle right here that led to this huge amount of supply stepping to the market itself. Right, some people like to call this order block, but at the end of the day, it's pretty much quite similar. Now, over here, what we have was this demand zone. Once again, how do you refine this? You can just refine it to the pivot candle that led to the breakout itself. So this pretty much becomes the refined pivot zone. And then I can also spot another demand zone right here. You can see what happens is that price goes up, started consolidate here a little bit before demand step into the market and push price up, right? So as a result, we can draw another demand zone right here at this pivot candle. And you can see there is more demand zone here as well, right? Price goes up, consolidate, go sideways a little bit before demand step into the market and push price up. So there we have our another demand zone right there, and we can refine it to either this pivot candle or use the first method, which requires you to take the entire range just like this. So yeah, those are the two methods to actually draw your supply and demand zones, the range method and the pivot method. And if you want to use the pivot method, there is a caveat to this. The more refined your zones are, the greater your risk to reward. But that also means there is a greater chance of you missing your trade entry. So for example, we have a refined pivot zone right here. But what happens is that price did not actually come down and tap into this pivot zone, right? You can see price just came down here and then just moved up. And in this case, you would have missed your trade entry because price has not mitigated your demand zone, right? So that is just something that you need to take note of. Compared to if you were to just mark out this entire range in the first place, you would have been tapped into the trade itself. So my advice would be choose what works for you, whether the range method or the pivot method, and then stick to it consistently. Don't use the range method sometimes and the pivot method sometimes. Once you have choose one that works for you, stick to it. We only want to trade high probability supply and demand zones. Because supply and demand zones, they are everywhere. Because there's like a constant battle between the bulls and bears every single day. If not, price will just be oscillating at fair value and just not going anywhere, just going sideways. However, if you follow the structure that I just taught you, you will be able to identify and spot supply and demand zones everywhere. But that does not mean that you should trade every single one of those zones. Because we only want to trade high probability supply and demand zones that are actually backed by financial institutions and smart money itself. So in order for a supply and demand zone to be considered as high probability, it has to meet the following requirements. Firstly, it must lead to a break of structure, right? We know that price will not just move up or down in a straight line. Price move up, pull back before going up even further. And when it break the last high, in this case, it give us a break of structure. Right? That is how productive I am. And it's all because of these 5 factors right here. So yeah, I hope you enjoyed this lesson, and just bear in mind that focus is extremely important. You need the ability to focus, and most people don't even have the ability to watch through a long video like this anymore because they are just constantly on TikTok and it's shortening their attention span, and all these dopamine ads is just going around and just ruining your fucking life. So yeah, I wouldn't recommend you to, or rather I would recommend you to actually go ahead and delete your social media. Once you delete social media, your life is going to be 10 times better. Trust me on this. The mindset and the habits of the top 1% trader. 1% trader. Okay, thing about this is that this is a very somewhat of like a boring topic to teach. But it's the most important thing that you can learn as a trader. Trust me, this is what's actually made me profitable. It's not the fucking trading strategy that actually made me profitable. This was the eureka moment when I was able to develop the mindset of a top 1% trader. And as boring as this is, right, I want you guys to focus. I genuinely want you guys to focus because I believe that this will have the ability to change your life and change your trading. I've already pretty much taught you guys everything I know about technical analysis through my Trading Blueprint 2.0 course and also through the past 2 master classes. This lesson will be fully focused on the mental part of it, right? To really sum up these 3 master classes. Talk about risk management, talk about trading strategy, talk about fundamental analysis also. The last thing I want to cover is the mindset, the trading psychology start. So let me just briefly share with you guys my mindset and the habits of the top 1 traders. First things first is to lose money. Lose money. Yes, that's the mindset of a top 1% trader. Is to focus on losing money and not making money. Right now you might be wondering why. Why would you focus on losing money? First things first, before you enter any single trade, you need to think about, okay, this is too big. Let me just say it to you. Before you enter any single trade, you need to think about how much money you can potentially lose on this trade instead of how much money you can make in this trade. Most of you guys, before you enter for the trade, you look at the risk to reward ratio, you see, oh my god, 1:5. Wow, sounds good. And then we put, okay, if I win this trade, I will make $500. But you never ever think about, oh, if I lose this trade, I might lose $500. That is why your job as a trader is to minimize your loss. And you can only do that when you think about how much money you could potentially lose before you enter for the trade. And also to make every trade in terms of R multiple. Now, what does it mean to make every single trade an R multiple? Like I said just now, do you notice how I talk about my trades? I talk about how, okay, you are risking this percent to make this percent. You're risking 10% to make 30%. You are risking 1R to make 3R. I don't talk in terms of capital. Let's say you have 2 guys right here, 2 traders. Trader A make $20,000. While trader B only makes about $1,000. Okay. Trader B risks $50 to make $1,000. Right? This was a super long swing trade, a super high risk to reward ratio trade. While trader A risks about $20,000 to make $20,000. Which one do you think is more impressive? Trader A or trader B? The guy who risks 20K to make 20K or the guy who risks $50 to make $1,000? Obviously, this trader right here. This trader was able to risk like a small capital to make a large amount of capital, to risk a small percentage of their total capital to make a large return. That is why when I say that you should focus on the R multiple and actually look at it in terms of R multiple, what I mean by that is that before you enter the trade, always think about how much R are you risking. So the rule just now I said for you guys is to risk 1% to 2% on each trade. So if you're risking 1R, your goal is to make 2R or more. Your goal is to at least double the amount of money that you're risking, at least. And that is why the concept of risk to reward ratio, you should aim for at least 1:3, or at least 1:2, right? 1:2 is the minimum. For me, it's the minimum. If the trade is less than 1:2 risk to reward ratio, I would not take the trade. Just stay out of the market at all. Like I said, yes, you can have the best property setup, the best setup, you can have all the confluences in the world. But if the trade is a 1:1 risk to reward ratio, I will not take that trade. As simple as that. I don't care how confident I am in that trade. I will just not take that trade. I stay true to my risk management plan. So think in terms of R right now. Don't just think in terms of, oh, I'm trying to grow this $100 account. How can I take this $100 to turn it into $200? Oh, you know what? Maybe I should risk $50 to make an additional $100. No, think in terms of R. If you risk $50, how much R is that? That's 50R, bro. You're risking 50R to make 100R. You're risking 50% of your account. That means what happens if you lose this 50R? Then you left 50R in your account. You left 50% of your capital in your account. And if you lose this again, guess what? You're just wiped out. You're clean. You have no money inside your account anymore. You just blown your account. Congratulations. So genuinely go think about this for a minute. Think about the R multiple and make every single trade an intelligent risk to reward decision. So right now I'm still talking about the mindset part. Later I'll talk about habits. This is still more on mindset, right? Firstly, think about how much money you can lose instead of how much money you can make. And also make every trade an intelligent risk to reward decision. Is to look at the R multiple. What else should I say? Lose money and protect the downside is the same as this. Okay. Another thing I want to talk about losses. Losses. I'm very, very fascinated with this because this is where you find true growth. You don't find profitability from analyzing your wins. You find profitability from analyzing your losses and figuring out what went wrong and figuring out how you can improve as a trader. Losses, you need to change the way you think about losses. At the start of trading, I always think that losses are bad. There's literally nothing good about losses. Oh, if I lose this money, guess what? I just lose my hard money, which I could have bought McDonald's or these Nike sneakers with it. There's nothing good about losses. But as time passes, I've been trading for what, 3, 4 years now? I learned that losses are actually good. Losses are the ones that are actually helping me to improve as a trader. It's not the wins. So generally look at your losses. Whenever you lose a trade, look at it and think about how you can not commit that same mistake again. So I want you guys to understand this. Okay, think about this. When you look at loss, ask yourself this. Why did I lose this trade? Not just this, why did I lose this trade? And then what can I learn from this loss? And how can I prevent myself from committing this mistake again? Whenever you encounter any sort of loss, look and ask yourself this question here. Ask yourself these questions. Because if you can ask yourself these questions and you can actually answer these questions, right? Guess what you unlock? You unlock a hidden gem. You unlock a hidden gem. And as time passes, you make more and more mistakes. You lose more and more money and you just unlock more hidden gems. And eventually, you'll be so wise and so good at trading. And it's all because you lost money. And also, trading will be extremely boring if you don't have losses. If you win every single trade, what the fuck is the point of trading? Anyways, losses is what makes trading somewhat rewarding. It's because you know that trading is extremely difficult and you've lost a bunch of money, that's what makes the end goal worth it. That's what makes the profits feel good because you have experienced the opposite part or opposite side of the spectrum. So change the way you think about losses. Okay, that's the third lesson. Maybe let me just give you guys one more lesson in terms of mindset. Emotions. When you're trading your hard-earned money, you will experience a ton of emotions like fear, greed, FOMO, even doubt. All these emotions will arise when you are trading with hard-earned money. The question becomes, how do you control your emotions? There's two modules that I created inside the trading blueprint that will help you learn about that. Peak performance trading, peak performance mindset, peak performance mindset, and also my trading psychology module. Those two modules, if you want an in-depth guide on this, go study those two modules. But let me just give you one important point. When you get emotional, this is the brain, by the way. This is the brain. When you get emotional, right? There's two parts of the brain. I don't know the exact science of this, all right? The prefrontal cortex or whatnot. I don't know the exact science. But I know this. When you get emotional, the emotional part of the brain, the part of the brain that actually give you that emotion, actually overtake the logical part of your brain. Isn't this quite fascinating? This is why when you argue with your partner, or okay, let's say your man, all right, you argue with your girlfriend, and you keep on explaining to her, okay, this is the rational way, this is the logical way, but she still continue arguing with you and telling you that she's right, and then she keep on arguing with you until eventually you give in and tell her, okay, you know what, you're right. Why? What does this happen? Because the emotional part of the brain take over the logical part of the brain, right? She is not thinking logically anymore. She is thinking emotionally. And why I find this so fascinating is because in trading, we learn about trading psychology and we learn about how we need to control our emotions when we are trading. But when these emotions arise, we cannot control them because the emotional part of the brain takes over the logical part of the brain. Now, in this case, what you need to do? What you need to do is first step is to be aware, is to take a step back and be aware of your emotions when they arise. Oh, I'm feeling greed. Oh, I'm feeling FOMO. Oh, I'm feeling doubt. And then when that happens, take a step back and reevaluate the whole situation and think whether you should actually enter for the trade or not. If you shouldn't enter for the trade, then don't enter for the trade. All right. So be aware of when the emotion arises and actually reevaluate the situation. And I think you should introduce some sort of pattern interrupt. That means once you're aware that, okay, you are experiencing fear, right? Stop trading, right? Stop trading and actually go for a walk or take a deep breath. Or just do something else other than look at the charts and then reevaluate the situation with a clear mind. That is when you can really learn how to control your emotions, somewhat control your emotions. I never really like this word control your emotions. I always think that it's not about controlling your emotions, it's about mastering your emotions. And this is how you can generally master your emotions by being aware and reevaluating the whole situation as a whole. Now, all these lessons right here, right, these mindset lessons are lessons that I've learned for the past 4 years. And I think they are the most important thing that you can genuinely know as a trader. Because if you can implement this, these are the things that will help you sustain in the game for the long term. If you're planning to trade for the long term, this is it. These are the keys. And another thing about trading psychology mindset is, okay, one last point. I promise you, one last point is plan. And actually, talking about plan, let's just move on to the habits of the top 1% trader. We have talked about the mindset. Now let's talk about the habits of top 1% trader. First habit, like I said, is plan. What does it mean to have a plan? Most importantly, follow a trading plan. I talk about this like 1,000 times on my YouTube, on the course, 1,000 times. And yet, a lot of you guys still will not follow this. To follow a trading plan is to develop a playbook. That means you must know exactly what will cause me to enter for the trade. Okay, what's my entry triggers? What setups should I enter for? Should I look out for so that I can enter for the trade? And then even when I do enter for the trade, where should I get out? And the thing about where you should get out, there's 2 points, right? Either your take profit or your stop loss. You need to plan both. Before you enter the trade, remember what I talked about. You should always start going in it with the mindset of thinking about how much money you can potentially lose. That's why you focus on choosing your stop loss first, right? Place your stop loss. Let's say this is a trade, right? Let's say you're trading at like a demand zone right here. Demand zone right here. And you enter for a buy right here. And you place your stop loss below this demand zone right here. This is your stop loss. Next, you'll place your take profit maybe at the next zone, which will be somewhere right around here. So you enter for this trade because you have your 4 confluences, because this was the high probability setups, right? And then place your stop loss below, place your take profit above. Now, in this case, inside your trading plan, you must also contain what is the minimum risk to reward ratio that will cause you to enter for the trade. And if it's less than this minimum risk to reward ratio, you will not enter for the trade. For me, it's 1:2. For you, can be 1:3 or 1:4. In this case right here, if my risk to reward ratio is 1:1, it means I'm risking this much to make this much the same amount. I will not take the trade. But in this case, it seems to be I'm risking 1% to make about, let's say, 4%. So this was a worth it trade and I will take that trade. Okay, so these are the things that should be inside your trading plan. There's obviously other things like which currency to focus on, which trading session to trade. And I actually have like a full trading plan for you guys. And if you go to the vault, you will know that I have this plan called the winning trading plan. It's like a full trading plan. This is just like a summary out of it. So go to the full trading plan and actually download it, create your own trading plan, and actually tweak it if you need to, because what works for me might not work for you. You might have a different trading style, scalping, swing trading, or whatnot. So tweak the trading plan and then follow it. Just follow it every single day and execute consistently. That's the first habit of a top 1% trader. Second habit would be to journal your trades. It's to journal your trades, right? I said this is very important because, like I said just now, losses are extremely important and extremely valuable. So you need to make sure every single loss count, and you do that by actually journaling down your trades. So what I do is that after the end of each trading day, after I'm done trading for the day, I will open the trading journal that I have and then just track down my trades. And what do I journal? Whatever I mentioned to you guys over here. Why did I lose this trade? What can I learn from this loss? How can I prevent myself from committing this mistake again? So this is for a loss. If I lose a trade today and I'm journaling, I will reflect about these few questions. Now, if I win, and I actually win a few trades in a row, I will think about just one question. How do I replicate this win? How can I ensure that I, replicate this win? Okay, very simple. Is to look for the same setup again, right? Look for the same setup. So loss and win, and that is what you need to put inside your trading journal. Next habit would be to track every single data. You need to have some form of like data tracker. You need to be able to track like, okay, on this date, I entered for this trade with risking about this percentage, and also with a 1:3 risk to reward ratio, and then this trade was a profit. So basically, you need to be able to track your data and have like this information inside your tracker. I would recommend you to actually do our Excel sheet and actually, yeah, just make sure that you track all this data. And I'm actually working on the data tracker right now. And once done, I'm gonna upload it inside the Vault so that you guys can use my own data tracker. the basically the spreadsheet that I use to track my data and stuff. So we talk about following a trading plan, we talk about journaling your trades, we talk about tracking your every single data. Third thing is to back test consistently. Now, why this is so important is because the markets are changing, the environment is always changing, and what works for you now might not work for you later. There's a few phases of the market. There's the volatility part of the market. There's a okay, so let's say there's a bull market and a bear market, right? So bear market could be like a huge downtrend, long-term downtrend, and then bull market could be a long-term uptrend. Within this bull or bear market, there is two phases. You're volatile and also you're quiet. So a bull volatile market it could be like this. A bull quiet market could be like this. A bear volatile market could be like this. Bear quiet market could be like this. Right? Basically, there's different phases of the market, and that is why one trading strategy might not work for all of these phases. Right? Maybe your price action trading strategy could work for this bull volatile market. This setup could work for this bull volatile market. Then you might look for pullbacks during this bull volatile. But then what happens during the bear volatile? How are you gonna trading bear volatile? I mean, like bull quiet. How are you gonna trade during the bull quiet environment? Okay, in this case, you need to switch up your trading strategy. This is when maybe you can use your supply and demand zones, right? Take advantage of all these supply and demand zones. So you can see, right? Depending on the market environment that you are in, you need to use a different trading strategy. That is why I preach backtest consistently because the market's environments are changing. They're always changing and you cannot control that. Only thing you can control is your own trading strategy and how you trade. That is why you should adjust your trading towards the ever-changing market environment. So do just that and make sure that you always backtest. You can backtest on TradingView or you can even backtest on the Forex Tester 5. There's a lot of software out there that you can use to backtest, right? So backtest consistently, follow your trading plan, journal your trades, track every single data.